and other related and other social and environmental issues, there's just more and more demand to think about how we, in how we manage capital markets, how we mobilize resources to address these kinds of issues, and to think about how to allocate capital in light of what that means for the changing context of business. We've got a record crowd for our 3 years of presenting this roundtable today. We've got quite a broad range of people. We've got Rotman faculty, Rotman PhD students, U of T students from beyond Rotman, faculty and students from other schools, and a few participants from other organizations as well. So welcome to you all. We're glad you could join us today for this Sustainable Finance Research Roundtable. We've got 4 speakers today. The format's pretty simple. Each speaker has 40 minutes in total for their presentation, but also to take Q&A as they wish. I'll try to keep the time moving along and keep it at 40 minutes per speaker. Between the second and third speakers, so between the first 2 and the last 2, we'll take about a 10-minute break just to let people get up away from the camera for a minute. This is set up as a regular Zoom meeting, not a webinar or live broadcast or anything like that. So the chat is open. The raise hand function under the reactions icon is open. So feel free to engage in those ways. I'm going to ask each speaker to indicate if they have any preference as to how, save questions to the end or take them as we go. Rod and I will be monitoring the chat and the hands and so on. So with that, I think we'll move right ahead to introducing the first speaker. First speaker is Ryan Riordan, professor and distinguished professor of finance and director of research at the Institute for Sustainable Finance at the Smith School of Business at Queen's University. Ryan's also the most recent recipient of the Bank of Canada's Governor's Award and was also named as a change maker last year in the Globe and Mail's report on business. Ryan is speaking today about carbon liquidity. So over to you, Ryan.
Thank you, Kenneth, and thank you everyone for attending, for organizing, for coming to listen. I unfortunately am not in any way affiliated with Rotman. I'm neither a former student nor a professor nor a current student, but I'm still happy to be here. I will share my slides, and here we go. Listening to my bio, I should note that I'm no longer the most recent recipient of the Bank of Canada Award, so I'm going to have to update that to a recent one, but nevertheless, all of the other things still apply. So thank you everyone for coming. I'm going to talk about a topic that is, I would say, near and dear to my heart. First of all, I love sustainable finance. But my first love, if it wasn't sustainable finance, it was market microstructure. So how markets operate, how liquidity is formed, how investors come to markets to buy and sell securities. And so this paper is, I would say, the happy marriage between market microstructure and sustainable finance. Now, the paper is joint with a professor at the Swiss Institute of Banking and Finance at the University of St. Gallen, Martin Nerlinger, and someone I've also co-authored previous sustainable finance papers with. In terms of the sort of the next 40 minutes or next 35 minutes or so, I'm fine if people want to ask questions in the chat. I've got the chat window open. If you want to put up your hand, and hopefully I can see it while I'm presenting. Sometimes it's kind of hard with my slides, but Rod has promised to jump in if there's a question, or if you're allowed to, just unmute yourself and ask a question. So I sort of much prefer the dynamic back and forth to the, listening to me speak for 35 minutes straight can get monotonous, even though I do like to listen to myself speak. Yeah, so with that, I'll just move right along. As soon as I find my mouse, there it is. So, for an audience like this, I probably don't really need to motivate, why sustainable finance, why we're looking at these types of things. But, these are slides that are artifacts of the last, 4 or 5 years, where people weren't really paying as much attention to climate change and sort of who's driving it and what's driving it. But what you see on the left is a simulated or reconstructed path of temperatures over the last 2,000 years. It's a really wide confidence interval around sort of 0 sort of tended down towards that sort of the ice age around 1500. And then you can sort of, you'll note this huge spike in average temperatures from 1850 to 2020, and well outside of our confidence interval of the last 2,000 years. And it's sort of a striking, obviously striking to most people, sort of a striking change in the path of temperatures. And then you juxtapose that with, well, is this something that's natural? I think we all probably are going to agree that it's not natural, but there are then other sources that show this sort of green, teal, I don't want to say I'm colorblind, but I'm not great with colors. Line along the bottom, this is our simulated or natural only path of temperatures, and the beige color sort of on top is sort of are observed, and this is where we simulate sort of human effects and natural effects. And really, what do we get out of this is, it's fairly clear to most, I would say, neutral observers that human activity is sort of the main cause of these large increases in temperature. I'll figure out my slides in a second here. And so this sort of, for someone who's in finance and interested, well, this should mean that we should really be looking at our firms that are listed, our regulators should be forcing the, or sort of paying attention to anyways, the disclosure that we have in financial markets. So the SEC, Gensler wants investors to for mandatory disclosure on climate risks. We have a push for the OSC in Canada, or the CSA, for our firms here to disclose more of their impact on the environment. And so this could include climate stress tests, as OSFI is asking for, individual firms disclosing their emissions, their consumption of natural habitat, their water usage, and then the impact the changing climate is going to have on them. So in the past, we've had climate disclosure were voluntary, and this had some issues, and we'll talk a little bit about the data issues later, right? If something's voluntary and it's not necessarily regulated, you can report in one year or disclose in one year, not disclose in another. Your disclosures might not be comparable to other firms that are disclosing in the same year, and might not even comparable for your firm from year to year. And I'm going to argue in this paper as well that really what we should have is sort of mandatory standardized disclosure, but even standardized voluntary disclosure would probably get us most of the way to what we need. There are also other pressures, right? It's not just the regulator or individual people like ourselves that are interested in more disclosure, and we want to know what we're investing in. So BlackRock has had is having some of the pressure on the firms that they invest in. CPPI, so the Canada Pension Plan Investment, used to be Investment Board, reported an intent to slowly decarbonize their portfolio. So there's a lot of pressure from individual investors that are saying, look, we've got a fiduciary duty to our clients, but this probably also includes looking at the impact of the environment, because those two probably aren't going to be able to be disentangled. In fact, they're probably correlated, and positively in the future. So looking at these things is going to be important. So it looks like a lot of the pressure is towards more disclosure, better disclosure for firms. But there's often been a discussion. Well, if you talk to the individual, the oil and gas sector, what are they going to say about this? Is like, well, investors don't really know what to do with this information. We're not quite sure what to do with this information. It might be misinterpreted. Let's not disclose, or let's disclose only parts, or let's opaquely disclose. And we're going to argue in this paper that that's probably not sort of the best way to go about it. And really, it's because this uncertainty is punished by market participants. So I forgot this slide, but I'll review it. So how much disclosure is happening, and how much is sort of happening over the globe? Well, here we can see Japanese, US, Canadian, European, and UK companies. This is a report actually by the chair of the Institute of Sustainable Finance, Sean Cleary, and one of our RAs that looked at, the focus was on a disclosure by Canadian companies. And here we can see in Japan, we're about 46 disclose, 54 don't. US, 67 do, 33 don't. Canada 68-32, Europe 79, and then UK companies 99 to 100. And this is the most recent snapshot. And in fact, in this paper, we're going to be looking at the US companies that disclose in the time series of these. And we do actually have I've got one table in the presentation that also looks at the UK, which is basically 100% mandatory disclosure, and we sort of see if our results hold in a different type of natural experiment or regulatory experiment, and we find that our results do hold. But there is, you can see there's a pretty good cross section of firms that disclose, and even now now it's 2022, but the data was from 2020. Here we see, even for Canada, it was 68% do some sort of a disclosure, and we're not even saying that it was good. Well, 32% don't disclose anything. So there's a lot of room and variation in the cross section, and we'll see also in the time series of disclosure.
Ryan, there was a quick question in the chat about disclosures. This is scope 1 and 2 only.
So in this slide here, we're talking about scope 1 and 2 particularly, but really this was a report that looked at whether or not they disclose anything at all, right? Do they have a sustainability report? Is there anything? What we're going to be looking at this paper is emissions in terms of scope 1 and scope 2, but this is any kind of sustainability disclosure. And so yes, we do ignore scope 3 if that was sort of the intent of the question, but yeah, scope 1 and scope 2. So this doesn't just sort of have an impact on industry, and it's not happening in a vacuum, right? There's some academic literature, and most of the academic literature on disclosure. In fact, we're really going to focus on one recent theory, well, not a recent story, not recent, I call it a seminal paper. It's the Diamond and Varecki 1991 paper that suggests that the resolution of information asymmetry is going to increase liquidity and trading after disclosure of valuation relevant information. What does this mean? It means that market participants and also intermediaries don't like uncertainty. And disclosing reduces uncertainty, and this reduction of uncertainty increases the amount of trading we should see in the market, and it should narrow our bid-ask spreads, which is sort of one of the sort of typical ways of measuring liquidity. We use a couple different measures just to sort of show that our results hold, but this is really the academic driver of this paper, is that reducing information asymmetry is good, and it really doesn't matter probably if it's with respect to emissions or if it's respect to other risks. The important thing is that if we do see a response, right, if we do resolve uncertainty and we see results, this also should tell us that investors and intermediaries do actually care about emissions and the uncertainty surrounding emissions. There's a couple of papers that have tested this, in the literature. This is really, sort of a small selection of these. The 2014 paper shows that firms can causally impact the liquidity via voluntary disclosure. So firms disclose voluntarily and they can cause their spreads to narrow. There's the Easley and Harrow paper that showed that increased disclosure reduces the information gathering costs. So if it's less costly to gather information, then we're going to require less compensation for our intermediation. And Bolton and Kaperchek find that voluntary disclosure leads to lower stock returns for disclosing firms. And so you can think of this paper as being, fairly similar to the Bolton and Kaperchek paper, except we're looking at liquidity. So we're looking at bid and ask prices. And we really look sort of in the second half of the paper, we're looking at the resolution of uncertainty with respect to emissions. Yeah, and so there are a couple other papers, I don't want to skip over these, and we've got them here, including one of my own. But let me get maybe to the real question that we're asking, and then the data. So what do we do in this paper? We examine the impact of disclosing carbon emissions on the liquidity of firms' equity. And so further to Jan's question, this is scope 1 and scope 2. And I like to say, mostly as a joke, but also not as a joke, this paper, and this is the slide you should stay awake for. This is really the results in a nutshell. Firms with higher emissions have lower liquidity, right? So the more you're emitting, the wider are your spreads. But firms that disclose their emissions have higher liquidity. So if you look at the sample of firms that do disclose and the firms that don't disclose, those that do disclose have higher liquidity. And when those firms disclose their emissions, their spreads fall by at least 13%, right? So while higher emissions is worse for your liquidity, it's better to disclose them. And when you disclose, you actually get a sort of an increase in liquidity in our sample, for a long time period, 13% increase in your spread. So what are the implications? One of them, and I'll sort of show that this result holds fairly generally in a broad sort of study of subsamples that we find or that we look at in our data. So it could lead to an increase in voluntary carbon disclosure, right? We can't really find a case where disclosing your emissions was bad, right? Even if the market is underestimating your emissions, if you're an early disclosure in your industry, if you're a late disclosure in the industry, if you're a high carbon intensity disclosure or a low, we really couldn't find. There are probably individuals we could pick out, but we couldn't really find a subsample that made any sense to look at where the firms were better off not disclosing their carbon emissions. So this should also encourage financial regulators to implement mandatory carbon emissions. We also show in the sort of the mandatory experiment in the UK that we have broadly the same results. So mandatory doesn't seem to change anything. If you're worried about, well, voluntary disclosure is this really weird subsample, and when they're disclosing it when it's good, and you can think of some endogeneity concerns, but insofar as an exogenous mandatory event allays those concerns of endogeneity, we've got that. And really, we're just hoping, as the research director for the Institute of Sustainable Finance, hoping to improve public discourse and public policy. And of course, as an academic, I just want to write a good rigorous paper. So all of these things hopefully go together. So where does our data come from? So we use a lot of data, and we show actually in appendix, it doesn't really matter which one of these three data sets that we use, our results hold. But what we use for the main analysis is we use CDP, so formerly the Carbon Disclosure Project, Refinitiv and Sustainalytics for carbon disclosure. And our sample period starts in January 2003 and goes right up to December 2020. And we actually have the update for 2021 now. I don't have it, but my co-author in St. Gallen has it, and he's working on the update. But this is fairly recent. We get crisp bid-ask spread data from January 2000 to December 2020. We have done a little bit of the intraday spreads, but going back to 2003, it just takes a long time to process. So we just don't quite have that yet. But we've got our end of day bid-ask spreads. We get our firm characteristics from CompuStat, and we've got two samples of firms. We've got our US firms, so it's about 11,500. So we're talking about a lot of firms, and some of them are very small. We've also restricted it to just large market capitalization firms, and our results hold. And then our UK firms, and like I said, there's just one sort of test at the end where we look at UK firms, and they're about 700. So what are the main variables, and what are we going to be looking at? So the first one is a carbon disclosure dummy. It equals 1 if a firm discloses carbon emissions data during the specific month. And we've got carbon emissions themselves, so not just a category dummy 0 or 1. We have their actual emissions, and this is their scope 1 and their scope 2 emissions. And then we calculate a measure. Yes, I know there are multiple measures of carbon intensity. We use 1, and that's carbon emissions divided by net sales. And then 2 variables, just a normal bid-ask spread in cents. And we take a look at the quoted or the relative bid-ask spread, which is just the ask minus the bid in parentheses divided by the mid. So it's really simple liquidity. We do also look later at the Hejazi liquidity measure. We look at a log version of quoted spreads. We look at trading volume, and everything goes in exactly the same direction as the quoted bid-ask spread. So here are some of our descriptive statistics. So we've got close to 1 million firm month observations in the US sample. Bid-ask spreads in cents are relatively wide, because you remember we're going back all the way to 2003, which is actually the reg NMS period. So this is so 9 cents wide, median is 3 cents or 3.5 cents wide. The relative bid-ask spread is about 82 basis points, and now we're talking for a lot of stocks on about 8 or 5, depending on the the price of the stock. But the log bid-ask spread, the Hejazi liquidity measure, and then log volume, and then these two variables, carbon emissions. And if I'm not mistaken, this is in megatons, and then carbon intensity, which is going to be megatons divided by, I think, millions in net sales, but I'd have to go back and look at the paper if you want to know the exact units. So I've got, how many more minutes do I have left? 20 minutes, roughly 25 minutes. So I'm going to get to some of our results now. So first, this is an idea about the sample of disclosing and non-disclosing firms and how the time series of these firms sort of develops. And I'll explain this little bump up and this bump down here. You see, starting in 2003, we start to see firms disclosing, but even in 2008, 2009, 2010, sort of the end of 2010, we still really do not see a lot of firms that are disclosing. This huge jump right here isn't because of any kind of most people would be like, oh, there must have been a change in regulation. There wasn't. This is really just us adding the Sustainalytics data. So here we have the Sustainalytics data. This is when they start recording. Emissions, and so we get this data, and we only have the data to 2017. So here you see a drop off, but here you can see that the CDP data sort of picks up in the Sustainalytics, and we get them sort of towards the end. We run all of our main results anyways on just a CDP sample, just a Sustainalytics sample, and just a Refinitiv sample, and we get exactly the same results. So it doesn't seem to be that we get one result with one data set or in one time period, and so we're fairly sure. Of course, you can never be sure, and so I'll always just say fairly sure that any of the results we see isn't being driven by our data sets specifically. So the first question we ask is, do higher emissions mean higher spreads, right? Another way of formulating that is, do intermediaries even really care about emissions, right? So intermediaries, or anyone that's sort of setting the bid-ask spread. And here we have a bunch of controls in all of these, so not just the ones that you see here, but this is a presentation, so I'm trying to present just the numbers that are relevant to understand what we're doing. But we've got a number of other controls. The first regression specification here has no fixed effects. The second one has fixed effects. So these are for our cent regressions, and these are for our relative spread regressions. And here we can see higher emissions means a wider bid-ask spread, so that's about a quarter or 50 cents higher. Remember, our average was about 9 cents, although some of this happens in the later period, so it's could be 50 cents on a 5 cent spread. And so here we see in relative terms, this is about 2.2 basis points or 1.8 basis points. So non-trivial impact. A 1 standard deviation increase in the in emissions leads to a 27 or a 50. 27 cent or a 0.27 cent or a 0.5 cent increase, or 2.2 or 1.8 basis points. And it doesn't really matter if we've got fixed effects or we don't, or we've tried a bunch of controls. Everything holds relatively well. And another result that I promised I would tell you about is non-disclosures versus carbon disclosures. I've got a probit. I also just decided to leave the probit out. I think the main message that you get from the probit is the message I'm going to tell you here, is that while we certainly do see much larger or wider bid-ask spreads for non-disclosures, 10 cents versus 2 cents, or in relative terms, about 94 basis points versus 10 basis points, there is a relatively big difference between the two. And the difference is that firms that disclose carbon emissions are just much larger, right? And so here we can see in trading volume, they trade more often. The log of total assets is higher. The book to market ratio is a little bit lower. The differences are all significant. Really, the message you should get out of this, and it also shows up, like I said, in the probit, is that most of the disclosures, or the easiest way to predict whether or not a firm is going to disclose or not, is based on the industry that they're in. Now, in a probit regression, like I said, that I'm not showing you here, we tried a number of things. Do other firms in the industry also disclose? Did not seem to have an impact. Do they disclose higher than average emissions? Didn't really seem to. It was really the most consistently significant finding was that large firms are just much more likely to disclose their emissions. So now I think we have a little bit of an idea, how many firms are disclosing, what's the time series of disclosure, what's the difference between disclosures and non-disclosures. We'll get what I would say is to the easiest part to digest, or the part where it's really difficult to come up with an endogenous story about why this is happening, and it's completely unrelated to emissions. And it's basically a series of staggered voluntary disclosure decisions over time, and what happens to liquidity for these individual firms when they decide to initiate the disclosure. So what happens when firms initiate disclosure? Here's a really simple time series graph. And what do we see? Right, this is the impact of disclosure and carbon liquidity. This red box around the middle is the disclosure month. Orange is pre-disclosure. Blue is post-disclosure. Here we're looking at cents. So on average, right, we're gonna, these firms that are disclosing are much higher liquidity than the average. So if you have that 9 cents in your head, disclosing firms have on average smaller bid-ask spreads or tighter bid-ask spreads. It goes from about 4 cents, and yeah, there's a little bit of a downtrend from, what was it, I don't know, 4.25 down to 3.98. But when we see on the, in the month of disclosure, we see a large drop of almost 30 cents, and then, sort of continues on its way. So that's pretty good visual evidence that disclosing our liquidity, or disclosing our carbon emissions is having a positive impact on liquidity in the form of getting a tighter bid-ask spread. So visual evidence usually doesn't work at the top journals. Jan, I just see a question. Yeah, does disclosure of carbon emissions go together with also initiating other more broad disclosure? That's a good question. The answer to that is probably no. We have looked at it, and there are some measures of sort of disclosure quality. We couldn't find any correlation, and in particular, disclosure month here is for CDP anyways, is actually the July 1st is when most of this data gets released, and most of the other disclosure happens in sort of February to March, when people are disclosing their sort of the annual report and not the quarterly. So usually big changes in other disclosure quality happens 3 months prior. So that would be happening, -4, -3, and not in July. We don't have a definitive answer. We can't, reject the hypothesis, but certainly it doesn't look like there's a lot of evidence of that. But it is it's a good question. So moving from visual evidence, which is great for presentations, not great for referees. We run some regressions, similar regression to before. We've got our bid-ask spread in cents. The first 2 columns are relative bid-ask spread. In the second 2 columns, fixed effects across the way for all of these. We do show in a really simple, where we just have carbon disclosure, 1 over price and log volumes. We just sort of show in a really straightforward, simple regression that we get our results. And then in a fully specified regression, we also find our results. So what do we see? That upon initiation of the disclosure of carbon, the bid-ask spread falls by about 0.5 cent, or the relative falls by about 3.3 basis points to about 2.2 basis points. So it's a relatively solid result. You'd expect that from seeing the figure. Around 1,600 firms initiate disclosure, spread out over almost 20 years, right? And so this isn't, if you remember back to the figure that I showed you, this isn't all happening in 2008 or 2009 or 2010. These are hundreds of firms sort of spread out over 20 years each year initiating disclosure. So if you're worried about one single big bang, one thing happening at the same time, I think it's a really difficult story to tell. So it looks to me fairly compelling that disclosing your carbon emissions is good for liquidity. And so we do a really quick matched pair sample. So if you're worried that the firms that are disclosing liquidity, their emissions, they're just doing it because something else is going on that's good for the market, right? It's like, oh, spreads are good anyways, and we expect spreads to get better. So this is a really good time for us to disclose emissions because it's sort of going to get lost in the wash. Investors won't worry about it too much because liquidity is just generally getting better. And here we show, for a match sample, it gets harder later to match, to do a really good match of firms. But here you can look at them all on. I hear a question coming in, but it's just hard to understand. If you want to type it in, then I can get to it. Maybe that's the easiest way to do it. Okay, I'll move on, and if I see it pop up in the chat box, then I'll get to you. So in this figure, the top line are the firms that don't disclose, but are similar in terms of market capitalization and trading volume. We tried a number of matches, and mostly get this sort of a similar effect. Here you see starting point is pretty close in spreads. The set of firms that do disclose, right? We see this drop in the sort of decline, anyways, in the bid-ask spread. Large event effect, and then it sort of continues on. And while there is a tiny little bit of a bump downwards, and these are also same industry, right? So we're matching industry, market capitalization, and trading volume. So they might be, benefiting a little bit from the halo effect, right? If some of the large emitters or some of the other firms in industry are disclosing emissions, they are resolving a little bit of the uncertainty for firms that aren't disclosing. So it looks like they might be benefiting just from a halo or sort of an indirect effect. But here we see, quite clearly that this isn't a broad industry or July effect that we're seeing. It really looks like it's specific to the firms that are initiating disclosure. So we run this regression and run a match pair analysis, find exactly the same thing. What I mean is visual evidence matches the regression evidence. We use other measures of liquidity as well. We look at the log of the bid-ask spread, so percentage changes in the spread. We take a look at log volume. We see an increase in trading volume around disclosure. We see a decrease in the Amahud illiquidity measure. So a decrease in the illiquidity measure means an increase in liquidity. So these three other measures also match our sample. Question from Naomi. Do you make a distinction between disclosure by the firm's management and disclosure by third parties? So disclosure at CDP is actually management disclosure. So CDP is a voluntary disclosure mechanism. So firms have to voluntarily decide whether or not they're going to report through CDP. So CDP data is only voluntary disclosure. Sustainalytics and Refinitiv actually purchase the CDP data. So the base of Refinitiv and Sustainalytics is actually the CDP data. Then they go off and they comb through sustainability reports as well. And so these are all firm disclosed reports. Some of them firm disclosed through CDP. Often they're also through sustainability reports. You'll find in the later data that most of the time the firms report through CDP and then report the same thing on their sustainability reports. So all, for the most part anyways, voluntary management disclosure, and then our data providers just sort of pick up this data. Does that answer your question? Maybe? I guess so.
Yes, thank you.
Okay, great. And so some of the questions people could have at the end, and I'll try to, Rod, do I have 3 minutes left or do I have 8 minutes left? I don't have I've got till 45, right?
That's right. So I've got 37 and you got till 45.
Great, okay, perfect, thanks. So some of the questions you could ask are, well, is there a subsample of the population for whom disclosure isn't good, or subsample of the firms where disclosure isn't good? And so one of the things we looked at as well, what about looking at returns? We can sort these into positive returns and negative returns, and we can look at high absolute and low absolute returns. And so what we see is high absolute returns, right, tells us that there was some uncertainty that was being resolved, right? Because around the disclosure, there was, volatility was high, suggesting that people weren't expecting this information. And here we find, in fact, it really doesn't matter how you cut the data, but we see spreads decrease, spreads decrease, spreads decrease. But even for the high information asymmetry, if you want to, take our proxy as measuring that, we find negative, statistically significant, and larger than the low information asymmetry resolution part of the sample. We also look at high CO2 intensity. So people, I shouldn't say people, but firms might think, oh, we don't want to disclose our carbon emissions. We know what our carbon emissions are. We know what our intensity is. And compared to everyone else that's disclosing, our CO2 intensity, our carbon intensity is really high. So it's going to be bad. We're not going to get any of these benefits. And here we find that for high CO2 intensity firms, we also find that the spreads come in, roughly the same as carbon disclosures. In fact, maybe even a little bit higher. I should have mentioned, but it's probably obvious by now. We do have a whole number of other control variables. We're not just running this on sort of one dummy variable and sorting it. I just don't want to report all of the same numbers over and over again. And these are also with firm fixed effects. Another question we got as well, are all of the benefits accruing to the firms in an industry that disclose early? And so here what we do is we take a look at the first 10% of firms in an industry that disclose, take a look at their impact on the bid-ask, well, their impact on their own bid-ask spread by disclosing, and the impact for firms that disclose later. Can't remember what we actually ended up on, I think the last 33%. But it really didn't matter if we took the first 10%, the last 90%, the first 10%, the last 10%. We really pretty much always found a negative and significant coefficient here. So even if you're high CO2 intensity firm, or an early discloser, or a late discloser, or a low CO2 intensity firm, it looks like you're getting the benefit of tighter spreads. Here we decided, it's like, well, we can probably come up with a pretty good estimate of what the market thinks that the CO2 emissions are, right? So we run a relatively simple regression based on what other firms in your industry are reporting for emissions, then the coefficients on things like number of employees, net income, revenue, well, and the industry that you're in. So we built basically an estimate, or the market estimate we thought of what CO2 emissions would be. I mean, it's a really simple statistical estimate. It's not us going around and taking a look at the individual plants and where they are and comparing those things, but I'd say a market-based estimate. And we separated them into low absolute estimation difference and high absolute estimation difference. So again, you could think of this as being low information asymmetry and high information asymmetry that's being resolved. And here we find, as we would expect, if we think the Diamond and Verrecchia model is telling us something useful, that firms where their high information asymmetry is being resolved actually has a wider, or sort of a bigger decrease in the spreads, which really suggests that because of the high information asymmetry, a lot of the uncertainty, spreads were particularly wide, and as soon as it was resolved, it came in. Jan, you've got a question?
Yeah, this is a bit more complex, so I thought I'd raise my hand. Thanks.
Yeah.
And I'm worried about only 3 minutes. So when you started, you said, look, this all points in the direction of firms should disclose more, both internally and perhaps also as a regulator. So one of the worries to give regulatory advice is, let's say we kind of nudge firms to disclose more. There's pretty decent evidence emerging that firms push down their emissions down to foreign supply chains. There's a paper out and it's pretty reasonable. So to what extent are you comfortable, let's say we believe all of this, to what extent are you comfortable saying this gives us some regulatory advice? Because you're not really measuring what the firms might then do in response in terms of their actual operational things they do.
Yeah, I mean, that's really asking the normative or positive just question, right? I mean, normative.
Well, you opened it. I wasn't going to ask it. You said maybe we should force them to disclose more. So anyway, never mind.
I'm not disagreeing with you. I'm just saying that's sort of the normative part. The positive part of me says, hey, this is good. The normative part of me says, well, we've got to think about indirect effects, right? What are the things that these firms are going to be doing? There is a lot of this sort of, outsourcing of high emissions. I mean, there you got to think about maybe scope 3, better ways to capture this. Perhaps they have to disclose these types of things, right? If they're just sort of spin off emissions disclosure, there are ways to do it. I am concerned about it as well. I mean, we know that firms are going to find, sneaky is perhaps the wrong word, but creative ways of reducing their emissions without actually reducing.
Right. We just don't want to push them there, right? By forcing them to disclose some things. Anyway, thank you so much. This was really cool. I appreciate it.
I agree.
So Ryan, we've got, I know Olaf has a question. We've got just a couple of minutes if there's anything you want to blitz through, and then we can grab a question or two.
I'll do it. Mandatory disclosure. We find basically the same results in the UK. We rerun the whole sort of battery of things. This was a one-off mandatory disclosure for UK. I was almost at the end. In fact, I kind of made it. I think I probably made the points. Disclosure means more trading, more liquidity. Initiating disclosure leads to increased liquidity, and it holds in a mandatory setting. And Jan says I should be careful, so I will. But I would say let's encourage the disclosure of emissions. We should be careful of what the effects actually are on the firm, whether or not we're actually reducing emissions or if we're reducing reported emissions. Those are two completely different things. Thank you very much. And Olaf.
Yeah, coming back to that, disclosure theory says even if you are a bad performer, it's good for you if you disclose.
Yeah.
And and so it's not even the question, whether good, whether they greenwashed and even don't need to greenwash. But I think what is important is that we should probably less focusing on standardizing the reporting, but standardizing how we assess the performance at the end. It doesn't matter in a way whether someone really transparently reports that they are really bad in their GHG emissions. That will increase the liquidity, but doesn't have any, it's not good at the end. So the question then is, should we continue focusing on standardizing, regulating, reporting, or should we rather regulate benchmarking on how much they can emit or what we think is good or bad?
Well, one thing I'll answer them real quick. I'm sure Rod's wondering how long we're going to do this. I'm not going to take too much more time. One thing we know that disclosing is good, but emitting more is bad, right? We do show at the very start, and I didn't talk about it a lot. It was a long time ago, I know, but more emissions means wider spreads. So intermediaries do not like, or people setting prices or whoever it is, investors, do not like more emissions. So they punish firms with lower liquidity. And the one thing I would say actually kind of to both questions is, one thing we're assuming is that there's a subset of firms that we can sort of outsource this to that don't report. I think the solution would be having all firms everywhere report, right? And then it doesn't really make a lot of sense, even if it's a private firm. If it's who doesn't really matter. If they're emitting, then we should have that, and we should have a way to evaluate that. And I know it's a big disclosure issue, and it's going to take forever. And how do we get private firms to disclose? However, the positivist in me would say if we just get everyone to disclose, then it's really hard to hide. And maybe I'll just leave it with that.
Great. Thanks so much, Ryan. That's a really interesting paper, lively discussion. So thank you so much. And with that, I'm just going to keep things barreling ahead and introduce the next speaker, which is Basma Majerbi, who's an associate professor of finance from the Gustavson School at the University of Victoria. She's currently leading the development of the Vancouver Island Impact Investing Hub, which is an integrated, multidisciplinary, solutions-driven platform that generates knowledge and builds capacity in impact investing and climate finance. Basma is speaking today on the global menu of sustainable funds, intentionality versus real outcomes. Welcome, Basma. Over to you.
Okay, thanks, Ken. I'm going to just start by sharing my screen, and I'll wait for your signal to let me know. Can you see my slides?
We can see it. Yep.
Okay, perfect. Yeah, so I'm actually not able to see the chat at the moment. So if there is a question, if you can let me know, that would be great. I'd like to start by acknowledging with respect the Lekwungen peoples on whose traditional territory the University of Victoria stands, and the Songhees, Esquimalt, and the Sanish people whose historical relationship with the land continues to this day. So thank you very much for inviting me to present this paper. This is joint work with Ali Shahrad, who is a postdoctoral fellow at the Gustavson School of Business. And the title here is a little bit different from what you have in the on the flyer for the roundtable, but really the motivation here, as you will see in a moment, whether intentionality behind the approach to sustainable investing matters for performance of funds. So what I'm going to start just state a few objectives here, because this is really like an exploratory study. The objectives here is we're looking at a new sustainable investment attribute that has been introduced by Morningstar, as I will mention. I will explain a little bit more later. We're looking at the global landscape of sustainable mutual funds, and what is different here in looking at sustainable mutual funds using these attributes is that it actually these funds are categorized based on manager intentionality that is disclosed in their regulatory filings. So it's a new classification, and we try to understand, okay, what is the landscape globally, and then we analyze the fund performance by type of sustainable investment strategy. We look at both financial and non-financial performance. By non-financial, I mean indicators of sustainability metrics. And then we discuss, I'll discuss some implications here. Okay, so for those of you who are not familiar with the mutual fund industry, it is actually a significant, it grew significantly in size, and it represents a very a significant source of capital for companies, as we know, but also for governments and so all sorts of economic activities. So what you can see here by 2020, what is referred to as regulated open-end funds globally reached reached $63 trillion. So these include both mutual funds and ETFs, so exchange traded funds. This is a really important sector to actually pool funding capital, particularly from retail investor. I just want to show you a few of the latest figures here. this is just for the United States, which is actually where the largest market is. You can see that the majority are mutual funds, even though exchange traded funds have been increasing in importance recently. But importantly, for my point here on the focus on how important this is for retail investors, in the US household ownership of these registered funds, you have 100 million individuals, 60 million households who have their savings in these mutual funds. And on average, the median number per person is like 4 funds owned by person. It's also a significant source of, investment for retirements, as we know, and so on. Okay. Now, we know that there's also some research or some data recently showing that the net fund flows that has been increasing despite the COVID-19 crisis has been primarily driven by retail investors, right? The challenge, though, for retail investors, obviously, who don't have a lot of capacity to distinguish between, different ESG investing strategies and so on, which could also lead to skepticism, is that, there are so many different approaches to sustainable investing and different labels and different ratings and so on. And so it's a bit confusing, obviously, for everybody, but including those who we want to mobilize more. In this case, if retail investors are interested, and we know there is a lot of research showing increased interest in ESG investing, particularly by the young generations and so on. And so we're seeing recently the fund industry responding by creating new funds and explicitly tailoring these sustainable investment strategies around different, like specific ESG criteria. In Canada, those of you who are familiar with the, another point to my motivation, those of you who are familiar with the sustainable, the expert panel in sustainable finance, and Ryan will recognize this because this is a study done by the Institute of Sustainable Finance. There is a recommendation to help Canadians connect their savings with climate objectives or ESG objective more broadly, but you can see that the progress on this particular recommendation has been very slow compared to progress on other types of recommendation to accelerate sustainable finance in Canada. Okay, so there is a lot. There is this issue of which type of investment approach is gaining a lot of attention, in my opinion, and we've seen asset managers and others trying to really tailor their products. So this is something from MSCI that destined to financial advisors, telling them, these are the top five sustainable investing questions. And the number one question is, which type of sustainable investing strategy is right for my clients, okay? And here we distinguish between impact investing, socially responsible investing, ESG integration, of other refinements that we observe happening recently. So going back to the mutual fund industry, we've seen a little bit of a shift recently to actually try to help investors with some sort of sustainability assessment of mutual funds. So in 2016, Morningstar released its famous sustainability ratings. Each of these, most of the funds in the universe of mutual funds or ETFs receive a rating, which is known as the globe rating. So you can have 1 globe or 5 globes, 5 being the best sustainability rating. And this is actually based on holdings of each fund. So they look at different sustainability performance of all the holdings. They have very strict methodology. It's very transparent. Really interesting to look at. The important thing, though, is that this rating is relative, just like ESG rating for companies, where companies are rated according to their industry peers and so on. Here, it's kind of not according to industry peers, but we look at the universe of funds, the top 10% best sustainable, that they receive the best sustainability scores, receive 5 globes, and then the lowest 10% have 1 globe, and so on. So it gives you a bit of an idea about the sustainability of funds. And then later they introduced something more different, which is called the low carbon designation. So now funds will receive a low carbon designation depending on their carbon risk score, and then depending on fossil fuel involvement. And there are certain thresholds and criteria according to which a fund will receive low carbon designation or not. So again, this is all in an effort to kind of help investors make sense of the sustainability features of different funds and help them make choice. Now, the question, of course, from an academic perspective as well as a practitioner perspective, to what extent do these different attributes and categorization of funds really matter for investor demand? And it turns out that there is actually a big impact. There's a significant impact in terms of, impact of these categorizations. So this is a paper published in Journal of Finance by Hartman and Sussman, and they look specifically at the introduction of these sustainability ratings by Morningstar. So they focus only on the US market and looked at equity funds, and there has been a significant increase in net flows in the US market right at the introduction of the sustainability scores for funds. Now, keep in mind that these funds existed right before, but now there is like a signaling effect. It just mentioned that these are they are categorized as sustainable funds, and then it attracts investors in a significant way. Okay. So what we do in this paper, we look at the next iteration of these, this trend of actually trying to categorize funds to help investors make choice. And so the most recent one was a categorization that looks at intentionality of managers of funds. And again, this is called the Sustainable Attributes Framework. Each fund is being assigned a specific sustainable investment strategy type that is based on investor on the manager intentionality. Okay, so you can look at the way they are actually categorizing funds. There's not just about, there's a metric for sustainability, whether the fund is sustainable or not, but we refine this a little bit more by looking whether the fund is an ESG fund, an impact fund, or an environmental sector fund. So again, in ESG, they separate between incorporation and engagement. I think this category has been removed now. I looked recently, and they are now having only ESG funds, no separation. But within the impact space, again, there are different themes that are also reflective of, interest by investors in tailoring further their sustainable investment strategy to meet specific goals. And then these environmental sector funds, they are actually non-diversified funds that focus on environmental thematics like renewable, water focus, and these are the three that they are using here, depending on what's mentioned in regulatory filings. Okay, so So again, from the literature perspective, and this is why I mean the motivation for this paper, in addition to what I just mentioned, from the academic point of view, a lot of the research on sustainable funds tend to focus on comparing performance of sustainable funds with conventional funds, and there's a lot of research here. There's the evidence is mixed. I mean, lots of studies show outperformance, others show, you know, there is no difference. There is a lot of research that looks at resilience, and we also look at this a little bit in this paper. But there is little research that actually compares different sustainable investment strategies and how they compare to each other. Despite the rise of these different categories, as I mentioned, in practice, you have, you know, differences in approaches to sustainable investing. There is evidence in the literature that some salient attributes, they really matter for consumer choice, not just in investment, but also in, you know, product, general, you know, consumer choices. There's been some theoretical models as well as empirical evidence. I'm not citing everything here, basically suggesting that categories can have a significant impact on investor decision making. Okay, whether you know it is whether the categories actually reflect the outcome that investors are trying to reach or not. That's a separate question that we try to tentatively look at in this study. Okay, so so basically what I'm going to do here is to present to you a little bit what we find by looking at this at the new categorization of funds based on manager intentionality, looking at all these categories, break them down, and then also analyze performance during including performance during COVID-19 shock. And the most important part, I think, is looking at whether these different categories of funds, because they are positioned differently for their clients, if they actually have different performance from a sustainability point of view. This is a really tricky one, and everybody knows that it's kind of hard to assess real outcomes from these sustainable investment strategies. But I will, you know, in the paper, we try to look at some metrics that are available and then present some initial evidence about that. Okay, so before I proceed, I just want to, you know, for those of you who are not familiar with the different investment strategy, I want to highlight how these are actually defined in the Morningstar universe. And so when I present some of the visualization about the different types of funds, you can connect them with these different categories. So when we talk about ESG funds, so these are basically defined compared to the other ones. They incorporate ESG criteria into the investment process or through engagement activities. The important thing is that they actually need to have ESG criteria as central part of their security selection. It's not just, you know, we take this into consideration, but it has to play a central role. With impact funds, on the other hand, they are positioned a little bit differently, even in the mutual fund space. We know this happens in private markets, but in the mutual fund space here, it says that funds that seek to make measurable impact in specific issue areas alongside financial returns. So in general, they focus on specific themes or use the UN Sustainable Development Framework to evaluate, for evaluating and the overall impact of the portfolio. Okay, and they have different thematics again. And then finally, for the environmental sector fund, I mean, you might think that we also have impact funds that have environmental focus and so on. But these ones are defined a little bit differently. They are non-diversified funds that invest in environmentally oriented industries. And so, like, you know, renewables, water focus, and so on. Okay, so what do we have? What do we find here? I'm going to give you, I have a lot of graphs actually, so I'm going to just present to you what is the landscape when funds are categorized using these different attributes. So first, looking at the number of funds, we can see at the broad category levels, the ESG, impact, and environmental funds. So this, remember, this is like a kind of a new classification. So we can see in terms of numbers, obviously ESG funds dominate. It's a much larger number of funds in the market. And you can see a drop here. I will show you a little bit more what happened here. But there's a trend to the rise, but then there's actually a decline here because of a stricter definition of what ESG fund means. On the impact space, we see a significant increase in the overall number of funds that are actually positioned as impact funds. And then you can see primarily on the, in terms of thematics, there's like environmental seems to be the largest one, followed by low carbon funds as well. But overall, the trend is to the rise in terms of number of funds, but also obviously market size. And then same thing we observe for the environmental funds. These are non-diversified funds, as I mentioned, with the renewable energy being the largest category. And now it's important to note that these are not mutually exclusive. So we actually looked at the, how these actually, one fund, for example, can be at the same time an impact fund, but also have an ESG focus or use the ESG in their selection criteria, and so on. So there is a bit of overlap between the funds. Okay. In terms of, this is just to show that it's mostly mutual funds. There's only, the ETF, which is, everybody knows, is very, there's a huge growth in ETFs, but in the sustainability space, they remain actually very low number compared to mutual funds and actively managed funds. And they're primarily, we can see they're mostly equity funds. There is an increase in fixed income, as well as allocation funds, which are a mix of equity and fixed income. But primarily, they remain dominated by equity funds, which is not surprising because we know we have more data on ESG for equities than for other asset classes. So what happened here is in January 2020, there's been a change in the definition. And so this is what it says. It says that ESG incorporation will no longer include funds that incorporate ESG into their investments process, but do not make ESG criteria as a key part of their security selection and portfolio construction. So again, there's a lot of concern about greenwashing, right? And everybody's talking about ESG and so on. So there's been a stricter definition. And so at that time, a lot of the funds that used to be classified as ESG fund were not given that, assigned that attribute anymore. So there's been a significant decrease in the number of funds, and they tended to be actually pretty large funds because in terms of total net assets, you can see there has been a huge decrease in the total net assets of sustainable funds. The other categories do not seem to be affected that much. Okay, so I just want to finish my overview here. Basically, what happened here in this big drop, it's mainly driven by North American funds. Okay, so if you look at what we have here, this is Europe. The number of funds continue to increase in sustainable funds, but mainly in North America, a lot of these funds that were categorized as ESG funds were not anymore. And you can see also the huge drop in TNA total net assets of the sustainable fund in the North American region. If you look at them country by country, it's mostly the US. So a lot of funds in the US were not categorized as ESG funds anymore. And also in Canada, there is a huge drop. So again, this is in billion of TNA by country, a huge drop in the United States and Canada. Okay, so we look at the financial performance of these different sustainable fund strategies, and first thing we look at is the cumulative returns. I know Ryan mentioned earlier that visualization is not the best. We do actually have a lot of regressions, but as I'll go over those in a minute. But for the sake of the presentation, I'm showing a few of these regressions here. Sorry, the visualization. So just to give you an idea about how these fund strategies compare to each other. So in the purple line, what you see here is basically this is the whole universe of equity funds. We only look at equity funds because the universe is really, really big to take everything. But for the sustainability funds, they are mostly dominated by equity funds, but we also include the other asset classes here. So you can see that, you know, compared to the other non-sustainable funds, there's a huge difference here in terms of cumulative returns. And in particular, when we look at excess return over the prospectus benchmark of each of these funds, again, it seems like the environmental funds overall seems to be outperforming their benchmarks over this period, and then also impact funds as well. Same thing goes with ESG funds. So the next thing, this is the COVID-19 shock. What you see here again is that consistent with a lot of evidence that has been discussed in media and other studies showing strong performance of ESG or sustainable fund during the COVID-19 crisis. So this is again the universe of the entire Morningstar funds, and you can see the huge outflow in funds during the period between March and April, and then you can see that contrary to what happened to conventional funds, these funds that are actually characterized as sustainable funds, the drop has not been as significant. Now, obviously, these different funds have different sizes. So when we look at cumulative net flow in percentage of the total net assets for each of these types of funds, you can see the ones that are saw the most significant increase in flows are actually the impact fund, followed by the environmental fund. I see a hand. I think there's a hand risen. Jan, do you have a question? Sorry.
Yeah, just a quick question. So a lot of the funds that get classified as you know, sort of sustainable are very tech heavy. So if you kind of look at what some of the holdings are, they've got the technology firms in them, and we know those did very, very well during COVID. Is there a way to disentangle those two effects a little bit and kind of put the sustainable and non-sustainable on equal footing, just to take out the tech effect to some extent?
Yeah, so that's a good point. I mean, I'll go through the next, you know, we did a number of analysis. We haven't looked at particularly the sectoral composition of these funds. But you're right. I mean, there's been a number of, particularly in the ESG space, where you have metrics like carbon intensity, you know, as a selection criteria and other things. So we look at those ones actually later on, but without focusing on sector by sector. So, but it would be interesting to look at the composition, right? In terms of, at this point, the objective is, okay, this is a new classification. What's the landscape? What goes into this category? What goes into this category? What matters? You know, are they different in terms of performance? How did they behave during COVID? And then also, most importantly, how do they differ in terms of some of the key sustainability metrics that are popular with investors? So we're trying to look at those, and then maybe the next step is to understand what are the drivers, right? I mean, but that's a really good point. I think I'm running a little bit out of time, so let me just show you some of the results. Obviously, we know the this is we do a difference in difference like an event study to see which of these strategies actually performed better during COVID. And to do that, we actually defined the pre-crisis, crisis, and recovery period using some of the established studies that we mentioned in the paper. And then they are defined using actually Pastor and Borsat's study 2020, though these are the periods between February and March. This is the crash period and then the recovery period. And in this here, we actually look not only at the sustainable funds by intentionality attribute, but we also include the ones that are 5 stars versus, for example, 1 star, like the globe specification that is assigned to funds. Okay, so we can see just visually, you can see basically low sustainability funds were performing less, and then high sustainability funds by globe rating. These are the green ones, were much higher in terms of cumulative returns. But then the dark line here is what is called the sustainable investment attribute by intentionality. Okay, so this is looking at the entire universe of equity funds here in this analysis. I'm going to skip this for the interest of time, and just show you what we did in terms of the event study here. So basically, what we do here is we know that there has been like a strong performance of sustainable funds before COVID, and so. But the question is, we want to see like what happened during COVID. So what we do is we regress weekly net flows of these funds, on several dummies. So category, looking at whether the fund is an ESG fund, an impact fund, an environmental fund. And then we use an interaction term between, with the crisis period. Okay, so, and then what we see that when we look at the interaction, so yeah, obviously there's been a strong flow in ESG funds overall during the entire period. But during the crisis period, where the strongest or like the most significant, the positive interaction here, meaning higher net flow, or basically significant statistically, is for impact funds. You can see that has been very strong. We also control for a number of variables that have been used in the Hartzman-Sussman JF paper, looking at past returns, looking at also fund size and other characteristics. And also we also control for the fact whether the fund has like a low here, one globe or 5 globes, right? So this, again, this is using the entire universe of equity funds in Morningstar, and we're trying to see whether these particular sustainable funds performed a little bit differently. So this is during the entire COVID crisis period. And then when we break it down into crash period and recovery period, again, what we see is the interaction term is significant, particularly positive and significant, particularly for the impact funds. It's positive for the other ones, but it's not statistically significant. So suggesting that there is a little bit more resilience of funds that are positioned as impact funds. There hasn't been a lot of net outflows in these funds. Okay, so I get to the last objective, which is basically looking at the non-financial metrics. And this is a tricky one, very difficult, as many of you know. But when you look at the methodology and the motivation behind these type of intentionality, in their methodology paper, Morningstar says that these sustainable attributes, this framework allows investors to make better decisions with insights about how fund managers are positioning their funds in terms of their sustainability goals. So these attributes reflect the intention and not the outcome. So obviously the question is whether the outcome is consistent with the intention. And that's the question, the big question that many want to answer. So to do that, we are limited basically with what metrics exist, right? So we look at a few of the metrics that are available in the Morningstar mutual funds universe. So there are sustainability scores. You can look at environmental score, social score, governance score. They also mention, like what's the percentage of asset under management in a given fund that is covered by ESG. There's a carbon risk score. I'm going to focus on these three here because they tend to attract a lot of attention and also interest from both institutional and retail investors. So the involvement in fossil fuel, the carbon intensity, and the carbon solution involvement. So if you think about it, if you position a fund as trying to contribute positively to the environment, you would expect that if this is incorporated in the selection, investment selection process, then at least you will see that in the indicators, right, of the fund performance, performing better than others. So again, we look at ESG fund, impact funds, and then environmental sector fund. And then we also look at, how this is the sustainability rating using the globes, which is very famous, as I showed you at the beginning, comparing low versus high. Lots of numbers here. I don't expect you to understand all the significance here, but in terms of, I'm going to just show you here in terms of, for example, a few indicators here, and then I'll also. So in terms of carbon intensity, for example, you can see that, and this is probably not a bit surprising, in the sense that the environmental sector fund tend to have the highest carbon intensity compared to other types of funds, and but on the other hand, what you see if you look at other metrics such as carbon solution involvement, you see that these environmental funds obviously have the highest level of rating when it comes to assessing carbon solution involvement. And I see Rod has a hand here.
Yes, indeed, Mazer. We love to give you a couple more minutes, but we'll be wrapping up soon.
Okay. Yeah. Okay. So I'm going to just maybe illustrate this. Just with me, just quickly. Maybe I'll focus on these environmental funds. Okay. So on the environmental funds, again, we look at the distribution, right? So even though the table that I showed you before just looks at the average metric, we look at the distribution of funds, and you can see that the red one here is like all funds in the Morningstar universe, and then we look at the impact funds. Okay, so you can see that the impact funds, the green line, that you have like more funds that have a higher rating in terms of carbon solution, but there are a lot of funds actually that are positioned as impact funds, but they have similar let's say sustainability assessment in terms of carbon solution to other funds that are not considered or positioned as impact funds. I mean, you see this all over, depending on regardless of the sustainable investing strategy. But what we see is within the category, again, there is not a huge difference when it comes to assessing carbon solutions. You can see that, for example, the ones that are gender focused tend to, many of the gender focused funds tend to have also a higher involvement in carbon solution. The low carbon, the ones that are actually specifically mentioned and in the regulatory finding that they are low carbon funds, are not necessarily performing better compared to other impact funds that are not specifically mentioning the focus on low carbon. And the other thing that I wanted to mention quickly here, and I'll stick to the visualization because I have other regression analysis to tease out these different metrics, but you can see, particularly with the environmental fund, and this was a bit, maybe comes to as a surprise to many people. We mentioned that they tend to have very high, I'm going to show you here, in terms of carbon intensity. So in general, environmental funds have very high carbon intensity compared to non-environmental funds. So to many non-environmental funds. It is primarily driven by these funds that are focused on water. And you can see that they tend to have like higher carbon intensity, but also the renewable energy funds, many of the renewable energy funds tend to have quite high carbon intensity as well. On the other hand, when you look at another metric, which is carbon solution involvement, you can see that the renewable funds, obviously, they have much higher impact in terms of carbon solutions, even though they tend to have like higher carbon intensity. I'm going to just skip here quickly and go to the conclusion. I know, Rod, we have to conclude here. So the most important message here is maybe I'll just mention this one. So in terms of sustainability performance, there's a lot of effort to try to kind of help investors by giving them signals. What is the type of investment strategy? What is, helping them align their choice with their goals? But what we see here is that these sustainability metrics are really kind of, they vary considerably across investment strategy, and it doesn't seem like manager intentionality is the best indicator of the potential outcome, okay? So the other thing is that some popular metrics, Ryan talked about carbon intensity earlier, and a lot of papers talk about carbon intensity. They may not be actually the best indicator of whether you are actually contributing solutions. So if you are an impact investor, looking at the fund with a low carbon intensity is not necessarily the best choice in terms of achieving your sustainability goal. And so we need a little bit more on this front. Sorry, I think I went over time, but I'm gonna stop here.
Thank you, Basma, and that was really interesting. I think there's a lot to be found in there. Ken?
Great. I was just going to echo that. Thank you so much for that presentation, Basma. And we wrapped right at 2:30. So I think we were scheduled to take a 10-minute break. What do you think, Rod? We'll reconvene at.
Let's make it quick so that we can get everybody else in as well. And there's so much to cover here, folks. So let's do what we can. And if you do have questions, maybe you can send them to speakers who aren't able to address them immediately and we can deal with it in the chat instead of directly. So thank you, Basma.
So we'll
Yeah, and I'll
start
stay here in case anyone has a question. I'm happy to answer that.
Super. And we'll start back promptly at 2:40 then.
2:40.
Just dive right in with introducing Walid, although anybody who had their speakers on over the break has already gotten a good introduction. So I'll introduce Walid Hejazi next. He's an associate professor of economic analysis and policy at Rotman. He's also a fellow at the Lee Chin Institute and a research fellow at Behavioral Economics in Action at Rotman, known as BEAR. He focuses on global competitiveness and international business and Islamic finance. He is speaking today about PPPs as a vehicle to attract global pools of capital into developing country infrastructure projects. I'll turn it over to you, Walid. We'll go into 320 for you.
320. Thanks so much. So 320. All right. Thanks so much for that, Ken. And thank you very much for the opportunity to be here today. This is work which is an extension of a project I led at the World Bank that looked at channeling global pools of capital into developing countries through infrastructure PPPs. It's also something that we hope to publish in a book, hopefully through Cambridge University Press. So there's a lot here, and this is sort of a different presentation than the two that you've seen before and the one that you'll see after. But we're going to cover a lot of ground to think about all of the challenges that the world is facing and how infrastructure PPPs can help alleviate some of the world's poverty. Okay, so, you know, when you think about global poverty, the world is still dealing with just a significant amount of poverty. And you look at the most recent numbers from the World Bank, 2017, so this is pre-pandemic, 9.2% of the world's population, or 700 million people lived on less than $1.90 a day, 24% on less than $3.20 a day, and 43% on less than $5.50 a day. So a lot of extreme poverty. Half of the poor are children. About 70% of the global poor aged 15 and over have no schooling or only some basic education. More than 40% of the global poor live in economies affected by fragility, and this number is expected to increase in the coming decade. These economies just represent 10% of the world's population. Over 2.4 billion people lack access to sort of improved or advanced sanitation. 663 million lack access to safe drinking water. Over 1 billion people live without access to electricity. And at least 1/3 of the world's rural population don't have all-weather roads. The bottom line is there's a lot of poverty that remains in the world, and it's encouraging that the United Nations came together and passed, you know, this UN Sustainable Development Goals, the idea that by the year 2030, so we're already 5 years into this 15-year journey, and we could talk about the extent to which we're achieving these really ambitious sustainable development goals. But the targets really are around eliminating extreme poverty. That actually in practice means a number like 3%, but reducing the amount of extreme poverty in the world. But it comes with a whole host of related activities, which I have here in red. Reduce poverty, strengthen food security, improve human health and education, mitigate climate change, construct resilient infrastructure, and that's sort of my focus today, and meet a range of other objectives across economic, social, and environmental spheres. When you think about this really tall order, is incredibly ambitious. Essentially what this comes down to is we want to achieve these 17 sustainable development goals. This underscores that ending extreme poverty and other deprivations must go hand in hand with strategies that improve health and education, reduce inequality, spur economic growth, all while tackling climate change and working to preserve our oceans and forests. And you can just stop for a few minutes and just reflect on the enormity of the task before us. This isn't just about eliminating poverty, but it's about achieving all of these other sustainable outcomes, gender equality, access to education and healthcare, and on and on and on. I pause here usually when I'm giving this presentation in person, and I usually ask people, you know, what is the country that you've gone to where you've experienced the most poverty? And one of the things that I had the the pleasure of doing and traveling with the World Bank around the world is actually meeting people from these many communities and just the challenges that they face on a day-to-day basis. It's quite remarkable how resilient people are, but what they go through just to get access to water, for example, in some of these remote communities is pretty remarkable. So let's think a bit about infrastructure and economic growth, which is really the focus of my talk today. There are many, many dimensions in achieving the UN SDGs. I'm going to focus on infrastructure and economic growth. So on the left here, I've just got the quality of infrastructure. You know, there's lots of rankings from the World Bank or the World Economic Forum, but there you can see Singapore, which is sort of the gold standard for infrastructure. It's also a small place, so it's relatively easy. For those of you that have been to some of the Gulf nations like Dubai, Abu Dhabi, or Qatar, phenomenal infrastructure, but it's a small place. The US and Canada are up there, you know, pretty good infrastructure. And then you see the heterogeneity. But if I go to the right and I put in some of these other markets, you know, Yemen is a conflict zone, but Mozambique, Uganda, Ethiopia, there's truly a huge gap in infrastructure around the world. The country I've been to where I've seen sort of the least developed, I'll say the worst infrastructure, was in Bolivia. It's pretty remarkable how much work is needed there in order to develop its infrastructure. You know, the US is not without its challenges. This is just from a month ago, and you know, it was important to raise this, that this is not just a developing country challenge. Even the most advanced countries have infrastructure challenges. This is when Biden, just like on January 28th, was in Pittsburgh, and he was going to talk about infrastructure. And on the day he was there, a bridge collapsed. Fortunately, no one died, but there were 10 injuries. And Biden went to that scene to give a little press conference because that was the theme of his talk. And for those of you that watched the State of the Union yesterday, a big part of it was about what the US is planning to do with infrastructure. Now, here's data on, you know, from the Global Infrastructure Hub. This is sort of an institute that serves the G20. On the left is data for, you know, 100 countries over a 15-year period. But on the right, I just pulled it out for 2020. And you just do this graph, and you can see along the horizontal axis is infrastructure investment per capita. On the vertical, it's GDP per capita. And it looks to be a pretty good relationship between infrastructure investment and GDP, or prosperity, I'll call it that. But of course, the issue of causality is absolutely essential here. A policymaker that interpreted this as causal simply would say, oh, I can go to any random country, increase infrastructure investment, and economic growth or GDP per capita would increase. Of course, that's not the case. That's not the case. So the big question to ask is, and this is what my research is about here, is there a causal relationship between infrastructure spending and economic growth? That's sort of one question. But more fundamentally, the question is going to be, under what conditions would we get a causal link? That's so very important, because some evidence I'll present in a minute shows that many countries in choosing infrastructure projects don't necessarily choose the best projects. There's tremendous cost overruns. There's long time delays. So if you look at the actual experience, often you don't see these causal relationships between infrastructure spend and economic growth. So I'm going to focus on with these public-private partnerships, and the whole idea is the extent to which a project can attract private sector funding, and bringing in the expertise of the private sector, can that result in better outcomes? Public-private partnerships are not the silver bullet, but there are situations where they work really, really well. Now, I'm going to take just a 3-minute diversion to talk about trade and growth. And why do I do that? Is because some of the models I'm going to look at shortly link infrastructure spending to a country's ability to engage in trade. Okay, and that's why I'm looking here at trade and growth, and then I'm going to look at infrastructure spend and try to link that to a country's ability to engage in the global economy. But there's so many other vectors of inquiry that we could think about. I'm thinking about that one there. But you know, you look at this sentence up here in red, the evidence is clear. No country in recent decades has achieved economic success in any substantial way without being engaged with the rest of the world. And the rising living standards that come with greater trade openness has lent widespread support to the idea that trade is a key input into economic growth. And here's 2 slides I'm going to show. These are all causal. These are not correlations. This is all evidence that's been demonstrated to be causal. And you look on the left and it looks at the impact of openness on GDP per capita. And what you can see is the impact is 2 to 5% or 2 to 6%. So countries that engage in the global economy experience higher levels of prosperity, higher levels of economic growth. This is not to say any random country should just open its borders to international trade. It's not that at all. But when countries are prepared to engage in the global economy, it results in higher levels of economic growth. But directly linked to the UN Sustainable Development Goals is this big finding right here. And the finding is that there's again, causal, one-to-one relationship between openness, so how much a country is engaged in the global economy, and income levels of the bottom quintile of the population. So this is the conversation I had with Jan earlier. With globalization, incomes rise, the bottom quintile benefit, maybe the top quintile benefits more, but that's a whole different question. But opening to the global economy, not just randomly, but causes improvements in economic performance. Okay. Now, when you look at, this is just, the remarkable. It's in one word, it's remarkable. The number of people that have been taken out of poverty as a result of the global economy. And I love what Michael Porter said when he came to Rotman. He said, there's not enough money in the whole world to help the world's poor. It's not through economic aid, although there has to be some of that. It's through creating economic opportunities. And you look, according to the World Bank, 1 billion people in East Asia and the Pacific alone were taken out of poverty. And while it all can't be attributed to trade, because there's lots of institutional developments and so on within the host market, it's remarkable how much the global economy has enhanced the prosperity of people in the world's poorest countries. Now, I look at the bottom left corner. This is the Rana Plaza collapse. And for those of you that have read about this, if you read some of the testimonials of what have happened, you wouldn't sleep. These are the horrible situation where this factory collapses. And if I was in person, I would point randomly at someone and just say, how many people died in that factory collapse? And I usually get answers from students like, 100 or 50 or 20, but the answer is over 1,000. 1,000 people died, 2,000 injured. And these are very, very poor people working in absolutely terrible working conditions. So on the right is from Human Rights Watch, but there's something called, Follow the Thread, where many of the big retailers in the West, when Rana Plaza collapsed, they said, oh, we didn't know our products were being produced there. There's this thing called supply chain transparency, where companies are forced to list all of their suppliers on their website. The best one I've seen is Fruit of the Loom, where they have a PDF with all of their suppliers. So what that means, if something bad happens at a supplier, they can't say we didn't know. But further to that, because that supplier is listed on their website, they have an incentive to ensure that the working conditions. I put these here to say that although globalization has delivered a lot, there's still work to be done. So I don't want anyone to think I'm sweeping that under the rug. That's really, really important. Now, when you think about this paper, this Donaldson paper in the AER in 2018, looks at the development of the railroad in India and wants to think about whether or not there's a causal link between the development of infrastructure and economic growth. This is a really nice paper, but in the opening paragraph, I want to stress this. He talks about linking his results to these models of trade and the mechanism by which infrastructure spend can improve economic prosperity, and it's through the reduction of transportation costs. So if you think about all of these models, improvement models or Samuelson models on how they model transportation costs, this is the mechanism that that Donaldson uses. So what does he do? he looks at each 20-kilometer increment in the development of the railroad in India. He looks at going into different communities or different counties, and he finds 3 results that are very, very strong. Railroads reduced the cost of trading, reduced inter-regional trade gaps, and increased trade volumes. Within the railroad network was, when the railroad network was extended to the average district, real agricultural incomes in that district increased by 16%. And of course, it's all linked to the gains from trade. So that's the power of this model. So this is the 2018 AER paper. He has a similar paper in 2016 in the QJE, where he looks at a similar analysis, looking at the introduction of the railway in the US economy. And in this literature, they do a lot of the analysis is counterfactuals, looking at what would have happened in these communities had we not had the railroad. And similar to his 2018 paper on India, he finds that the introduction of railroads has a huge impact on trade between counties, reducing the cost of trading and increasing incomes and land values. And if you look, this idea that, the counterfactual that had they not developed the railways, agricultural land, the prices would have fallen by something like 60% is pretty remarkable. So these 2 studies show causally that infrastructure has real outcomes. Now, here's one by our dear Nate Baum-Snow, who's a professor here at Rotman. And there's a huge debate in the literature about when governments develop expressways to go to suburbs. Does that cause the population to move from? Some people say, no, not really, because it's only when people move to the suburbs, then we build highways to accommodate the increased traffic. He uses this source of exogenous variation, this plan by the US military to build highways to all of these different communities across the US. And what does he find? Sure enough, he finds that a significant part of the reduction in population in city centers was driven by the introduction of highways. So these 3 studies, I start by talking about those because they show that infrastructure is causal in driving economic growth and prosperity. But there's something very important that we have to think about. When we have the first railway connecting communities across a country, whether it's India or the US, that's very, very different than infrastructure spending generally. So here we are in Canada, we already have these transcontinental railway, highway, we have railways and so on. And the question becomes, if you do introduce additional infrastructure, once you have that there, is there a causal relationship? And there's a tremendous amount of disagreement here. So here's a paper in the Oxford Review of Economics that looks at what's happened in China and argues that China has been much better than developed countries or democracies that they put it in identifying, building, and rolling out infrastructure. But what they show very clearly in this careful study is that there's a real imbalance, and they show data on how some roads in China are super busy and others are not. All of that to say that in the selection process, it's not optimal in the choice of which projects to pursue. And similarly, if you look at the cost, the cost estimates on these infrastructure projects they look at in China are on average 30% underestimated. So they come up with this conclusion that while infrastructure does not cause economic growth. But here's my jump off point. Here's the question. If you look at the reality of what's actually been done, what you can see is that often infrastructure investment doesn't cause growth, but I'm going to argue or test the extent to which appropriately procured, designed, constructed, financed infrastructure can lead to different results. Okay, so that's our jump off point. So let's look at some global infrastructure gaps. Okay, some global infrastructure gaps. And there's so many of these numbers, and it depends upon the source, it depends upon the class of infrastructure you look at, but I'll take McKinsey, why not? They talk about in 2015, numbers around $2.5 trillion of infrastructure investment, but over the next 15 years, in order to achieve the UN Sustainable Development Goals, we need like an extra $1 trillion a year. These numbers are simply mind-boggling. How on earth are we going to bridge these infrastructure gaps? And I will argue that PPPs are one method to tap into private pools of capital. And if you look here and on the left, why this is an important picture is because it shows the different classes of infrastructure. And all of these numbers that you see, when people talk about these massive infrastructure gaps, there's economic infrastructure, there's broader definitions of infrastructure to talk about social infrastructure, oil and gas and mining, and then there's real estate. So it depends on how broad you want to go. So we'll leave that discussion aside, but that's very important to this discussion. And this is I think probably one of the most important slides in this presentation. And on the left here, it shows the infrastructure gaps or the needs across countries or regions. 60% of the infrastructure needs are in the developing and emerging world. That's the first point. So even though there are infrastructure gaps in the US and Europe and Canada, most of the gaps in the needed capital is in the emerging world. And up here on the right, and this is really where, this is the important one. This is it, where there's this estimate, okay, that 38% of the infrastructure gap can be filled not by getting more money. It's not just about getting more money and plowing it into the same process, but it's around fact-based project selection, streamlining delivery, and making the most of existing infrastructure. That's the important point. And that's why getting the private sector involved is so very important. And as I said, it's not the silver bullet, but it's not simply around investing more money into the same sort of method or processes that we had in the past. This is my jump off point. This is very, very important. Rod, if there's a question, I can take it, so you can just interrupt me when you like.
Sure, thanks. There's actually a question in the chat. I don't know if you have access to it, but it's effectively, how do you deal with the potential trade-offs between infrastructure development and climate change and environmental issues? You might be handling that through the presentation, but that's come up.
That's a brilliant question. Whoever asked that, thank you so much for that. That's something I will talk about, but that's going to be one of the metrics we're going to look at. So that's one of the metrics we're going to look at, the extent to which the projects in our database achieve those. And I'll explain exactly what I mean, but that's a great question, a great question. So think about public-private partnerships. So these are long-term relationships between a government and a private entity to provide an asset or a service in which the private party bears significant risk, and remuneration is linked to performance. So they can play an important role in closing the infrastructure gap to channel funds from the private sector into the procurement and delivery of these kinds of infrastructure assets. This third bullet, I should have put it in red. I put a bunch of stuff in red, but not that, but that should have been in red. But by subjecting potential projects to the test of attracting private finance, it enhances private sector project selection, and lots of countries have implemented infrastructure. And I think the bottom one here is important. Well-structured PPPs bring private capital, private sector expertise, and commercial management incentives needed for enhancing service provision to users. So in the right situation, it can deliver significant value. There's so many different models: build, operate, transfer, build, transfer, operate. It depends upon the sponsor, it depends upon the jurisdiction, it depends upon the project, it depends upon the complexity. There's a whole lecture that we could have just talking about selecting the right one of these. But think of the cleanest, sort of the best example of where a public-private partnership would work best is you want a toll road. The government doesn't have the money. Basically, what can happen is it can put out a call for proposals. A private sector consortium can come in, build the road. It's very clear. It's like nothing too complicated. And what ends up happening is the private sector earns a return from charging a toll. Okay, so one of the big challenges with that, and I have to say, here's the big challenge when it comes to PPPs. Once a private sector builds a piece of infrastructure, there's an incentive, there's a tension between the government and the private company managing the asset under the terms of the PPP. Once that bridge is built, once that road is built, the government has every incentive to maximize its use. So the government has every incentive to renege on the contract with the private sector that delivered that asset. So they want to renege to the extent they can to bring down the cost for people to use the bridge to maximize its use. And so private sector then anticipates that. And that's one of the things that we're going to look at. So, you know, I love this slide. I love all of these slides, but they say one of the problem with economists is that when you have 3 economists in the room, you get 6 opinions. Well, if you watch these 2 here, you've got 4 policymakers and there's at least 20 opinions as to whether or not public-private partnerships work. And there are situations where they work. There are situations where they don't work. One example is you actually shift the risk from the government to the private sector consortium. They're supposed to bear that risk. The point, and so, but because it's higher risk, they're going to want to be compensated for that. The question becomes, if things don't go well, that private sector consortium may be able to walk away or renegotiate with the government. So there's lots of complexity here. But if you look, this is the Canadian Council for Public-Private Partnerships. You look, there's 200, this is from just a few days ago, 291 active projects, $139 billion of projects in Canada that are under the PPP model. You know, this is the Champlain Bridge. And I mentioned all of these different models. This one is design, build, finance, maintain, operate. And the value for money, you look at the savings, the idea is if you can bring the private sector in, they're able to deliver many benefits that otherwise would not be forthcoming. This is a straightforward example of something that works really, really well under the PPP model. This here is to build the Brampton Courthouse or a courthouse in the Toronto area. There are so many. These are several public-private partnerships that in the report that I led for the World Bank, these are case studies that we did, and these are examples of public-private partnerships across the developing world that when done properly lead to many benefits, including achieving goals consistent with the UN's Sustainable Development Goals. There is the holdup problem that we talked about, the idea that, you know, the government, once that project is done, they have the incentive to renege on the private sector in order to bring down the costs, in order to maximize usage. So, but the private sector, and here's the trade-off, all of the inefficiencies that come with the government delivering these services, if the private sector can come in and deliver these services, they can arrange the financing, they can do the design, the build, the finance, the operate, the maintain. Because returns are linked to performance, you bring private sector incentives into the procurement of public infrastructure. It's wrong when someone says the private sector owns the infrastructure, the government owns the infrastructure, but once the returns go back, once the private sector earns their rate of return and repaid their principal, the asset returns to the government unless there's a continuing relationship. So there's all of these critical success factors to look at the extent to which these public-private partnerships work: risk allocation, strong private consortium, political support, community and public support, and transparent procurement. All of these show that when you nail these, you're able to deliver better projects for the public sector than if it goes through the regular government procurement process. A really nice paper that just came out in a Journal of International Business Policy last year shows that if it's a domestic versus a foreign provider, that can impact the effectiveness or the efficacy of the PPP. Now let's think about the World Bank, right? It's got 170 client countries. It really works to help these client countries through technical assistance, helping them understand procurement more generally for infrastructure, but also within a PPP framework. And they've helped the delivery of lots of infrastructure in many of these different ways: roads, bridges, development of local water supplies, and so on. They also have something called MIGA, which I won't talk much about, but other to say that they provide political insurance to help private sector pools of capital when they actually do invest in areas to sort of eliminate non-commercial risks. So they will provide insurance against things like civil conflict or change in the government and those sorts of things, non-commercial risks. But here's, I think now what we really need to think about, and what this is this new data set that the World Bank has put together, which looks at how prepared countries are in 4 dimensions when it comes to their preparedness for public-private partnerships. So the blue, it basically just says how prepared are countries to procure infrastructure investment generally, and then the gold relates to public-private partnerships. And you can see by region down here, North America really, a star when it comes to PPPs, but some in the developing world really have a lot of room for improvement. So what we have is we have this data on, preparedness for PPPs, the procurement process for PPPs, how they deal with unsolicited proposals and contract management. And we have these for like 100 countries. So we're able to look at how sophisticated they are. And as you can see, this procurement sophistication or how well developed it is varies by region of the world. So here are the questions that we're looking at. Do those countries that are more developed in terms of PPP readiness attract more infrastructure investment generally? Then we ask the same question, do they attract more PPPs? Because for the project database that we have, we know if it's a private participation in infrastructure or if it's a PPP. The next one I think is the most interesting one, and this is the work. This is where the work really is in this project, is how does government reputation vis-a-vis past projects? So if we had a government that reneged on a contract with the private sector, how does it impact the terms of future contracts that it would have with the private sector in procuring additional procurement? And then finally, how does PPP infrastructure perform relative to achieving the UN SDGs? And so this is what we're working on. And so the data set that we are currently working on, but there's 3 of them that we have. This is the World Bank Private Participation in Infrastructure Database. And, we know if it's active or canceled. I could show some regression results to see whether, the mode is a PPP versus a non-PPP, how it impacts the outcome and whether the outcome was desirable or not. We know if it's a green field, a brown field. We know these different modes. Here I broke it up into 3 different histograms, because just to show the variation in size. So the first one are those projects less than 100 million. There's 5,300 of those in the data set. Between 100 million and a billion, there's 3,200. And then the over $1 billion, there's 360. We also look at the percentage of private sector participation. You can see there's a spike there at 50%, but there's also a spike at 100% as well. So we're able to look at things like how does private sector involvement impact the outcome of these PPPs, but we also have the extent to which capital comes from domestic versus foreign markets, how that too would influence these outcomes. Now, I think this is the hardest part of the project, and this is what we're doing now for each project that the World Bank has been involved in. One thing that we don't know, it's hard to know from public data if there's a problem in the delivery of a public-private partnership, say, extending some of the infrastructure in the Toronto and the GTA for public transit. The private sector goes to the provincial government, says, we can't deliver, we're going to walk away. We're just in way over our heads. So there's that renegotiation. You don't see that in most of these data sets. But what the World Bank does, and it's hard to see here, but for hundreds and hundreds of projects, they have these reports that give you all of the detail underlying each one of these infrastructure projects. So this particular document here is only, I think it's 26 pages, the report for this particular infrastructure project. But some of them are up to 100 pages long. So what we're doing now, we're at the process of coding all of these reports and then matching them to this infrastructure database, and then looking at how PPP readiness at the country level attracts private capital for the delivery of infrastructure, and how that maps into not desirable outcomes in terms of delivering on what the project was supposed to deliver, but also on all of these ESG metrics, and also cost, but the UN SDGs, but that's all in the reports, and that's where I'm at now. So Rod, I gave you additional 5 minutes because I wanted to make sure we had time for questions. So back over to you, Rod.
Thank you, Walid. And wow, when I saw your deck had 46 slides in it, I was slightly worried, but you powered through, so well done. Maybe we can start with the question from Olaf Weber around the environmental climate implications of PPPs and how work on this infrastructure goal and the SDGs might be compromised by having negative environmental effects, if I've got that question right.
Yeah, so that's a fabulous question. And it would seem to me that if you look at Basma's presentation, and if you look at all of that information on the amount of capital that is now committed to achieving the UN SDGs, I would argue that this is exactly the perfect marriage for PPPs. Because if I'm a global pool of capital and I want to channel some of that capital into a developing country, I would want to ensure that they're achieving those sustainable development goals. And, you know, Olaf knows this better than I do, but if you think about financial institutions, and now, you know, the disclosure of not the amount of omissions that they omit, because that's not a big number, but they have to report on the amount of emissions they're financing. I think this is a perfect marriage for global pools of capital committed to achieving the UN SDGs to get involved, to make sure that the development of new infrastructure in a developing world is the right kind of infrastructure. Great question. Any next question?
Let's go next. I think Christoph jumped up first. Did you have a question? Nope. So Olaf, did you have a follow-up on that?
No, thanks. No, it's no. It just no. I did a study, or we did a study here that, you know, international trade increases climate emissions. So, you know, you could say, okay, if you support infrastructure, you increase international trade and you increase climate emissions. You know, it's really about, you know, while we answer that in a way, we have to figure out what kind of infrastructure and whether it's really compatible with the SDGs, because SDG 8 in general is, you know, some say it doesn't really fit. It's contradicting all the other SDGs. So, but it's no, it's a great response. Thank you.
Yeah, thank you. And you know, you raise such an important conundrum. I would ask: imagine a developing country being able to embrace the development of infrastructure that would raise incomes per capita, reduce poverty, so achieving some of the SDGs, but at the same time raising emissions. So what is the trade-off? And I think this is the perfect marriage for all of those pools of capital committed to the SDGs. I think this is the perfect marriage. And I think the World Bank sort of at the middle to ensure this marriage results in those appropriate infrastructure. Now, I think the next question becomes, do we know what the right infrastructure is? And that's sort of another question.
Basma, I see you're up on screen. Do you have a question?
No, sorry. It's a great presentation. Thank you. And I think the infrastructure issue for developing markets definitely require a lot of capital, you know, to be pulled there. No, I didn't have any question. Thank you.
If I could,
we did just have another one come up in the chat. Do you see that, Walid? Can you have a PPP project integrating climate change concerns when emissions and pollution is not priced in the economy?
Yeah, that's a great question, but really that would require on the KPIs that the sponsor has for the private consortium. So the idea there would be, even if they're not priced, what would happen is the sponsor, meaning the government entity that wants this piece of infrastructure built, they would have to build in a KPI that if the private sector consortium did not achieve, they would be penalized. And that's why these global funds are so very important. These global funds are important because they want to make sure that the sponsor that goes to the private sector consortium to build this infrastructure, the global fund needs to say, what I want is I want one of the KPIs in there to be A, B, and C, but particularly around carbon emissions. And we're seeing that increasingly.
Great, thanks. Well, that brings us right to 3:20. So I think we'll wrap it up with those few questions. Thanks so much, Walid. That's a really nice contribution to the program today, and a great conversation. Thanks. So now I'd like to introduce our fourth and final speaker, Christoph Schiller. Christoph's an assistant professor of finance at the Carey School of Business at Arizona State. He's been there for, I think, 2 years since he, or maybe going on 3 years since he left Rotman, where he was a PhD student and graduated with a PhD in finance. Christoph's research interests are in corporate and international finance, with a focus on product markets, information diffusion, and corporate social responsibility. And he's speaking today on the cost of ESG investing. So over to you, Christoph.
Well, thank you so much for having me. Let me pull up my slides. I assume that everyone can see them now?
Yes.
Fantastic. All right. Thank you very, very much for including me in this incredible event. I will try to keep my eye on the chat window, but it's not really open in front of me right now. So please forgive me if I don't see your question right away. It's great to be back, although virtually at Rotman in Toronto. I wish it was in person, but maybe you can do that in a future year. So for something slightly different now, this paper is called The Cost of ESG Investing. This is joint work with my co-authors Laura Lindsay and Seth Pruitt, who are also both here at Arizona State University. This is relatively early work, so I'm looking forward to any and all comments and questions that you might have. They'll likely have a big impact on the project and help us improve this paper going forward. All right, so as I think I don't need to repeat or remind anyone in this particular group of people, the demand for ESG investment has been growing tremendously in the last couple of years. Sorry if I just interrupt. I think someone has a microphone on. There's a lot of feedback on my headphones. If that's Thank you. All right, so the demand for ESG investing has been growing tremendously over the last couple of years. The number of dollars under management have been going up. A lot of institutions have signed on to ESG responsibility declarations, and so as a result of this, fund managers who are running these types of vehicles, who are running these mutual funds and investment funds, are looking for ways that they can integrate their ESG goals in those investment funds. But the implications of doing that are still quite unclear. So traditionally, the view has always been that from a theoretical point of view, investors who have a preference for holding ESG type assets do not require as much compensation for holding these types of assets because they have a preference towards them. And as a result, we should have lower expected returns for these types of assets. And there is some support for this view in the literature. A number of the papers that I have listed here on the slide provide some evidence consistent with that, specifically looking sort of at sin stocks. There are also other papers that show the opposite or show an absence of this type of effect. And at the same time, we have some evidence in the literature now that ESG investors who claim to have ESG goals in their investment behavior do not actually implement any of those goals in their actual portfolios and in the actual investments. So there seems to be a bit of cheap talk going on. At the same time, if you look at the recent work, there's some evidence on several different types of costs that come with integrating ESG goals in investment portfolios, focusing, for example, on the benefits of diversification, looking at management fees, looking at the cost of running these types of funds and other frictions. And so, given this contradiction in the empirical literature, as well as this recent evidence that ESG investors don't really seem to be doing what they claim to be doing, we ask a pretty simple question in this project and in this paper. And the question is, hey, is it possible to form ESG portfolios to adhere to these ESG mandates without sacrificing much in terms of the risk return profile? Essentially, is it possible to form these ESG portfolios for free? And if yes, how is that possible? Why can we possibly do something like that? The way that we approach this problem is by bringing a new methodology that has been very, very successful in asset pricing recently to the table. This methodology is called the Instrumented Principal Component Analysis, or IPCA. And this methodology comes with a number of important advantages that help us, I think, contribute to this literature. First of all, the IPCA methodology is very, very good at extracting aggregate risks and sort of capturing what the mean variance frontier really is. This helps avoiding attributing certain risks to alpha that are actually just compensation for risk, just because your factor model is poor. Another advantage of this IPCA methodology, as I'm going to show you in a second, is it allows us to have time varying alphas, betas, or both. So they're both time varying and cross-sectionally varying, which helps us in this framework figure out if ESG ratings can capture exposure to systematic risks, or if they contain information about exploitable mispricing. Because of the way that this methodology works, it also allows us to take into consideration a really broad set of other information, conditioning information that investors already have access to when making investment decisions, in addition to these ESG scores. So we can really condition on the information set that investors have out there at any given point in time. And so we should really interpret what I'm going to show you as sort of conditional alphas and betas, which is what makes us different from the rest of the literature. And last, what we can do with this methodology is include not just sort of one data source, but ESG data from a number of different sources, which helps us make sure that our analysis is broad and not just specific to one index, but sort of makes a broader, more general point. The one slide that you should stay awake for is this one. Sort of the main takeaways from this research is that it is indeed possible to adjust systematic portfolios in a way that achieves a really broad range of different possible ESG mandates without giving up much in terms of the risk return relationship. That's not always 100% the case. So in some cases, yes, you give up a little bit, but for a very broad range of ESG mandates, it is possible to do that. How is that possible? How can we possibly achieve that? Well, it turns out the ESG measures in our data and in our model do not have any ability or do not help us predict future returns, neither in the form of alpha, when we include them sort of as information for mispricing, or in the form of beta when we think about exposure to systematic risk. And all of these statements are always sort of in the context of conditioning on this really broad and really rich information set that investors already have available at their hand when making these types of investment decisions. Is this inconsistent with the theory? Well, it turns out that it's not necessarily inconsistent. It can actually be very much consistent with equilibrium theory, and that's something we show sort of theoretically in the paper as well. As long as these ESG investors who implement given ESG mandates use different types of strategies and different measures, and as long as those measures and strategies don't necessarily perfectly agree with each other, it is possible for a broad range of investors to be implementing ESG mandates, and yet those not to result in lower expected returns in equilibrium. All right, so before I dive a little bit deeper into the results and talk about the data, let me give you a sort of a brief idea of what this IPCA methodology does and how it works. As most asset pricing models, in our IPCA model as well, expected returns in the next period are sort of a function of alpha and betas, which capture the exposure to systematic risk factors. What makes this IPCA methodology special and different from most asset pricing approaches is that both the alphas and the betas are time varying in the sample, because they are both instrumented with a broad range or a broad set of firm specific information that varies over time, right? So both alpha and beta are sort of instrumented by these firm characteristics, which gives us conditional exposures to systematic risk and conditional alphas after observing these firm characteristics. The second thing that makes this this methodology special is that we're not necessarily have to rely on the typical risk factors that the literature has used in the past, but we can also run this methodology while simultaneously estimating the factors themselves. And as Kelly and others have shown in some of their recent published papers, this approach of estimating the factors within the model helps achieve a much better sort of way of capturing the mean efficient frontier and capturing sort of systematic risks. All right, so by estimating this type of model, we're able to obtain measures of the conditional exposure to risks, our betas, the moments of these factors, which helps us sort of form a tangency portfolio that is implied by these moments. And so up to this point, I haven't said anything about ESG yet, or how we include ESG in this type of framework. What we do is two different things. The first approach that we use to sort of include ESG in this type of framework is what we call tilted systematic portfolios. So systematic portfolios just means that we're setting sigma alpha equal to 0, saying that essentially there is no mispricing, there is no conditional alpha, and all of the expected returns are due to exposure to systematic risks. Given that, we're able to form a tangency portfolio with these beta estimates, and then given this tangency portfolio, we're going to imply ESG tilts. So the first way that we're going to do this is we're going to overlay these portfolios with ESG characteristics and screen out certain firms or certain stocks based on their ESG characteristics. The second way we do this is in the context of two very prominent, recently published responsible investment models, the Peterson et al. 2020 model and the Passer et al. Model, which gives us ESG tilted Markowitz portfolios. The advantage of this approach is that it is a very sort of transparent way of forming these types of portfolios, and makes it very visible what the cost of including these ESG characteristics and these ESG tilts and filters is on the performance of these portfolios. The second way that we include ESG in this context is by forming non-systematic portfolios, which means in this context we're allowing for mispricing, or we're allowing for alpha to exist, conditional alpha to exist in this context. We can do this in a number of ways. We can either include ESG characteristics in the estimation of beta. We can include ESG characteristics in the estimation of the alphas, or we can include it in both. And that's exactly what we do. We do all three of those, which is going to help us identify if ESG characteristics can improve the formation of these tangency portfolios because they reveal something about the true exposure to systematic risk, or if they can help us improve the performance of these betas because they reveal something about mispricing, or about both of those two things at the same time. All right, so this is essentially the two prongs of our analysis. The first represents essentially sort of the typical negative or positive weighting or screening ESG strategies that we see a lot in the industry, ESG industry. The second is more of a inclusion of the ESG characteristics in the fundamental analysis of portfolio formation, which is also a very common strategy and mandate that ESG investors follow these days. All right, so let me talk a little bit about the data that goes into this analysis. Our non-ESG related data is fairly common and fairly standard. Returns are from CRISP. Firm characteristics are mostly from Compustat. We use a really broad set of characteristics, 50 different firm level characteristics to give us sort of the broadest possible number of firm month observations. We also do some robustness with slower moving characteristics to make sure that our results are not due to that. On the ESG side, we currently use 4 different ESG data sets from very commonly and well-known providers: KLD, Asset4, Sustainalytics, and RepRisk. And as you probably know, the coverage of these indices varies quite widely, both in the cross-section as well as in the time series. So as I'm going to show you, we're going to use a number of different cuts of these, a number of different subsamples of these to cover our basis and make sure that our conclusions are not due to sort of the use of just one of these indices, but are really broad and general. All right, so given this data set and given this methodology, let me dive into sort of our first set of results that focuses on these systematic strategies where we don't allow for alpha to exist, and just sort of form a tangency portfolio first, given all of this information that we have using the IPCA methodology, and then screen out firms based on the ESG characteristics to see, hey, how does this impact the portfolio performance that we found. All right, so one thing that is fairly well documented and well known is the fact that ESG coverage and availability of ESG scores skews very much towards large firms. So in our baseline estimations, we're going to focus on just large firms to make it possible to actually compare our results to a portfolio formed without sort of including ESG characteristics. As Kelly and others have shown, it's actually harder to provide evidence in this for just large firms. So this is almost a more stringent test. In the paper, we show that this is robust to using the entire sample as well. What I'm going to show you is sort of the baseline case where we focus on these larger firms. All right, and so this small table here on the slide shows you the performance of this tangency portfolio that we form with the IPCA methodology without taking ESG considerations into account. As you can see, the Sharpe ratio of 1.46 is very high. It's highly statistically significant. The average return per year of 14.58 is very high as well, with a high T statistic. And again, this is purely due to exposure to systematic risk and doesn't include any alpha here. So now what happens if I go ahead and take this portfolio and just drop out certain firms depending on their ESG performance? Well, this is potentially surprising for you. The surprising finding is not much, actually. So in this table here at the top, you see the performance of the portfolio if you do not include any sort of ESG screens. At the bottom, I show you what the result is when I... Is there a question? Sorry? Okay. If there is a question, put it in the chat. I'm going to try to look at it, and hopefully we can get to it otherwise after. So at the bottom, I show you what the performance of this portfolio looks like if I apply certain tilts or certain screens depending on the ESG performance of these firms. We have a number of different thresholds below which we set the weight of these firms essentially to 0. So we set that threshold to 25% or the 50th percentile or the 75th percentile. And you see that both for the 25th percentile and the 50th percentile, there is not much difference both in the Sharpe ratio as well as the average return compared to the systematic portfolio that's sort of optimal given all these other firm characteristics. This does also not really change if we only apply the screen in the long leg. So if we only drop firms that we would otherwise be going long that have bad ESG performance below the 25th or the 50th percentile, we still see almost unchanged Sharpe ratios and average performance here. The effects start to become visible when we have a very, very extreme sort of tilt and very extreme filter, as you would expect, right? If you start really throwing out a very, very large proportion of firms, especially only in the long leg, as we have here in the last line of the table, we see sort of a drop off in the Sharpe ratio and the mean return. So it's not without any constraint. It's not possible to push this statement to the very extreme, but for a pretty large set of possible strategies, it is possible to implement the type of mandate that ESG managers face and not sort of sacrifice much return. And going forward, I'm going to show you a few more cuts and a few more versions of this that makes essentially the same point. If you implement the Peterson et al. Model, which has sort of a socially responsible investor in the model who are trying to achieve an average sort of ESG score in their portfolio. We can implement that as well with our model estimates or with our moments for a number of different reasonable assumptions for what that average ESG score in the portfolio should be. Here indicated by this S bar, we still see that the Sharpe ratio is essentially unchanged relative to the systematic portfolio. The same is true if we implement the Pastor et al. Model, in which investors have sort of an ESG preference parameter or a taste parameter, here indicated with D. So you see, if D is a very, very high value, in this case 0.01, which puts a lot of emphasis and puts a lot of weight on ESG preference, we do see sort of a drop-off in the Sharpe ratio. But for more reasonable values of 0.01 or even smaller, we see again that the Sharpe ratios are very similar to the one that we would achieve if without implementing an ESG mandate. And this result holds for all kinds of different specifications that we can throw at this. The ones that I've shown you were for KLD specifically, but the same result comes through if we use ESG data from other data providers, if we only use specific subcomponents of these ESG scores, E, S, or G. It holds whether or not we impute missing values with a 0 or with a -0.5, which is sort of the lowest value that these scores can take in our sample, or if we focus only on those firms that have non-missing ESG scores, we can throw a best-in-class industry adjustment at this or other factors that have been typically used in the past in the literature. The result is very, very similar. And so the takeaway from this first section of the analysis is essentially, hey, it is totally possible to implement a broad range of different ESG mandates without actually sacrificing that much. The Sharpe ratios seem to remain pretty much unchanged, and the average returns as well stay very high and very statistically significant, right? So given this analysis and given this insight, an obvious question is, how is that possible? How can it be that we can throw out all of these firms and still achieve essentially unchanged portfolio performance? Well, to get to this question, what we do is ask the question, hey, do these ESG characteristics help us predict performance, help us predict returns, either in the form of giving us additional information about exposure to systematic risk, or in the form of conditional alpha in the form of mispricing. And so what we do in the second half of the analysis is include these ESG characteristics in our IPCA model in the model estimation stage in the first place, right? So we're going to either include this in only the betas or in only the alphas or in both of those things. And so what we have here in this table is the case where we include the ESG characteristics in both the alphas and the betas. So now here on the right-hand side, we allow for mispricing to exist to see if it is possible to form portfolios that are sort of orthogonal to these systematic risks and therefore sort of pure alpha strategies. And if those portfolios have any type of positive returns or any type of positive Sharpe ratios that are different from 0. So let's take a look at the right-hand side of this table first. What we see is that it is actually not possible to generate or form these portfolios, these pure alpha portfolios, with any sort of profitability. We see that none of the Sharpe ratios is indistinguishable from 0. The average returns of these portfolios are small. These are annualized returns and indistinguishable from 0 as well in terms of their statistical significance. On the left-hand side, we include these ESG characteristics in the firm characteristics that we use to condition, that we use to instrument for beta. And we see that in a similar way, including these ESG characteristics does not seem to help us actually form better tangency portfolios. The Sharpe ratios and average returns are no better or no higher than the Sharpe ratio we get without including these ESG characteristics, telling us that sort of including these ESG characteristics at the firm level doesn't really help us explain exposure to systematic risk any better than we would do without including them, or it doesn't help us form portfolios based on mispricing any better than we would be able to do without them. We also do the same analysis where we include all of the firm characteristics to estimate beta to capture the exposure to systematic risk, and all of these G characteristics in our set that we use to instrument for alpha to see if just using the ESG characteristics tells us something about mispricing. The answer is it does not, right? It doesn't really matter which data source we use here, KLD, Asset4, Sustainalytics, RepRisk, or how we sort of fill out our data set in case of missing ESG scores. In both cases, we see that Sharpe ratios are very close to zero and indistinguishable from zero. Statistically speaking, and the same thing is true for annualized returns as well. Right? And so similar to our previous analysis, we go through a broad range of different robustness tests using different data sets, different cuts of these data sets, subsamples, different ways of imputing missing values, other factors, and so forth and so forth. And the results seem to hold across all of these different ways of doing this analysis. And so taking this together, what we find is that there's no evidence that these ESG scores or ESG characteristics at the firm level help us define alphas that are successful with respect to sort of other asset pricing factors, and they're not successful. They do not help us tell anything about firms' exposures to systematic risks. In other words, to those conditional alphas or conditional betas, right? And so what we try to do next in the paper is relate those findings to the literature and sort of try to understand how it is possible that we do not find evidence that these characteristics help us generate alpha, while other papers in the literature have found evidence for that. And so specifically, we look at two closely related papers. One from the environmental dimension specifically, which is Pastor and others 2021's paper where they construct a green factor. In this paper, they construct a green factor and document that this green factor generates from a French alpha over a 10-year period, roughly since 2012. Edmonds has a very well-cited paper from 2011 in which he does something very similar on the social side, constructing a factor that is based on employment satisfaction from the best companies to work for data set, and finds that this portfolio generates Carhart alpha over sort of a 20-year span. And so what we do in our paper is we first actually successfully, almost to the T to the dot, are able to replicate both of their findings, documenting unconditional alpha when we're using sort of a standard cross-sectional asset pricing framework with time invariant betas and sort of unconditional alphas. So I can show you, for example, for Pastor and others, this is the replication of their result. However, when we integrate these characteristics that they use to form this environmental factor in the IPCA framework in our beta neutral portfolios, in other words, we're using all the firm characteristics to instrument for beta, and only this green factor as a characteristics to implement for alpha, we no longer find any kind of outperformance. We no longer find any kind of alpha for these types of strategies. The same thing is true when we replicate Edmonds' paper. We find the same exact results in an unconditional context. However, once we go to this conditional framework that we're applying, where we're conditioning for all of the other FEM characteristics and have time varying betas and time varying alphas, we no longer find this type of evidence. And so Pastor and others essentially argue that their finding in their paper is due to not the fact that we have sort of generally reliable alpha because of this environmental green factor, but because there were unexpected shocks to climate concerns, which have sort of increased ex post returns to holding high ESG or high environmental performance firms. And so from that perspective, our results really strengthen and confirm what Pastor and others have been arguing in their paper, but from a novel perspective, because we explicitly sort of condition in this framework and explicitly talk about conditional alphas and conditional betas. Lastly, from a theoretical point of view, you might ask the question, hey, how is this possible, right? We're showing that ESG scores don't really predict returns, neither in the form of alpha nor in the form of beta. And all of these investors out there have these big incentives to include ESG mandates in their portfolios. Doesn't that mean they're all just going to go out there, buy these firms that have high ESG scores to improve their ESG mandates or to fulfill their ESG mandates. And in the process of doing so, prices go up, expected returns go down, and we should be able to start predicting returns with these characteristics in that framework. Well, it turns out not necessarily. And the reason is, as I've just shown you, with these different ways of approaching ESG, there is not just one way of doing ESG, right? There are a number of different measures out there. There are a number of different strategies out there and ways of implementing these strategies. And if you take Pastor's paper and sort of extend the paper a little bit in this theoretical context, then that's something we do in the paper as well. I don't think I'll have time to show you the details of that. What comes out of the model pretty clearly is that it is possible for a broad range of investors to have an ESG mandate and actually implement those ESG mandates without that resulting in lower expected returns in an equilibrium setting, as long as these ESG scores and these ESG mandates are not significantly correlated with each other. In other words, as long as these ESG strategies and scores kind of disagree quite a bit with each other. And so we are taking a closer look at this to see, hey, do they actually disagree with each other? And so one piece of evidence is just this relatively simple sort of plot of the cross-sectional rank correlations across different scores and different firms. And the main thing to take away from this plot is the mass of this density plot is really centered at 0. In other words, the most typical type of correlation you'll find across these different ratings, rating agencies and scores and different years and different firms is 0, arguing that these different ratings that we can use to implement these strategies really do not agree very much with each other. Right, and so as long as they do not agree with each other in a model of the Pastor type, it's entirely possible to have no effect on expected returns in equilibrium, as long as investors can use different scores. And this is actually an interesting thing to think about going forward about this industry, about the industry of ESG ratings, as well as the industry of ESG portfolio managers. As a portfolio manager, there's a lot of evidence now suggesting that they have strong incentives to advertise and sort of market ESG mandates, as investors seem to value that, and it seems to generate inflows to these types of investment vehicles. And so there's a large incentive to advertise and market ESG mandates. However, as a manager of these funds, you do not really want to sacrifice returns, right? And so if maintaining a broad range of different ESG scores and a sort of zoo of different ESG ratings out there helps guarantee going forward that this will not affect expected returns, there might actually be an incentive to sort of uphold this zoo of different ESG scores going forward, and we might expect this broad range of measures and different ways of interpreting that exists right now to continue and to continue to flourish. Right, and so I think I'm coming up against the end of my time. So let me just quickly conclude what we do in this paper. As I showed you, it's possible to implement and achieve sort of really broad range of different ESG mandates without sacrificing much in terms of the risk-return trade-off for investors. How is that possible? Well, it's possible because we find that ESG scores do not help us predict returns going forward, neither in the form of alpha. So they do not give us extra information about sort of mispricing that the market hasn't captured yet, nor do they give us extra information about the conditional exposure to systematic risks that are not already captured in this broad range of other firm characteristics that we include in this set of information, right? And so all of what I said is sort of true in a conditional form, once conditioning on these other firm characteristics and observables that we consider. And so in equilibrium, this is not a contradiction with theory necessarily, as long as the way of implementing ESG and these scores don't agree with each other and have a very low correlation. It's entirely possible for a model to have no effect of ESG implementation for expected returns. Thank you very much. I am looking forward to any questions if there are any. I see some in the chat box now, so looking forward to that.
Great. I think we've got hands up and not questions in the chat as far as
okay.
I see.
Yeah.
So we'll go to Jan.
Okay, sorry. First, I have to apologize. I missed the first couple of minutes, so it's plausible that I missed this. Also, my PhD is now very dated. I know what to do in terms of short positions when you're looking at long, short alpha portfolios. What I don't quite know is, in this particular approach, whether there are any restrictions you have to impose on short positions, and how to think about shorting a bad ESG stock in this framework.
Yeah. So in our framework, the weights of the securities are essentially implied by the model estimates from the IPCA, right? So they give us the weights. In our implementation of ESG, we do this in a couple of different ways. So we have cases, or we have scenarios where we filter out firms only from the long end of the strategy, or from both the long end and the short end of the strategy. In both the Pastor and the Peterson models, you sort of need to have an aggregate positive investment. So you need to have an aggregate positive weight, which happens to be the case in the implied weights that we get for our stocks anyway in our model.
So you're not running into any solutions where you're saying, there seems to be a lot of short demand for a particular stock that my model isn't so happy with.
So coincidentally, the way that the model comes out with the weights that we're getting, we're not running into this constraint.
Okay, thank you very much.
Yeah.
And Olaf.
Yeah, I have a question. Maybe I understood something wrong. So it looks like it's a good news for investors because they can have portfolios with the same returns. But isn't it? Are these portfolios at the end then better from an environmental, social, and governance perspective, or is it just? So for my impression, I don't know. Maybe I understood it wrong, but
right.
It looks like, as you are laughing, I understood it correctly. It's not really. It doesn't really matter if you pick ESG criteria, because if you say it in a brutal way, the ESG criteria are kind of random or kind of not reliable. Let's say it like that. Is that correct?
I think you can speculate on that. I don't think our paper, our evidence allows you to draw sort of a definitive conclusion on that. Our objective setting out was essentially to understand if it is possible to implement these types of mandates. Whether these types of mandates are the mandates you should have or not is, I think, an entirely really interesting, but not necessarily something that we can answer, right? And so there is, I think, a reason, or there's justification for different ratings to exist that go beyond just fulfilling the manager's needs for having different ratings so that they can all put together their little strategy and not sort of hurt portfolio returns, right? These different ratings, they all have a reason for existing that goes beyond that to some degree. And so some investors care about a certain environmental outcome or a certain social outcome, others do not. And so a certain ratings agency might be the one that gives them this type of information. And so an ESG fund that implements that might give them exactly what they need, right? So it's possible for that still to be true, and these firms and portfolios to actually be better. But it's also entirely possible within our framework that these ratings disagree because they all measure noise and they have no correlation because they essentially don't tell us anything. That's also possible. That your preferred interpretation is a little bit up to you. Our results can't really speak to that. If you think that these ratings capture something and therefore implementing them in your portfolio captures something and filters out or overweighs the firms that you want to overweigh, then it does something without sacrificing too much return.
I just thought about indicators that have a clear connection to financial performance. Let's say costs of GHG emissions. If a company has higher costs of GHG emission, everything else is constant. It must have a better alpha than others,
right?
Because they have lower costs. And so why doesn't? And might be interesting to
absolutely. So I completely agree with you. I think one thing you can easily argue when looking at the scores that we are considering right now, while it is true that the asset management industry heavily relies on these scores, and it's sort of the primary metric that they use to construct these portfolios. They are made up of hundreds of different characteristics that you sort of munch together in some way that gives you a final ESG number. And a lot of noise and a lot of aggregation happens that might not capture what you want to capture. So one thing that we're adding in the paper right now is more objectively measurable and sort of quantifiable things like greenhouse gas emissions to see if this effect comes from the fact that we can hardly sort of interpret these types of scores and measure them properly, or if it comes from something else.
Thanks a lot.
Great, Ines, I'll give you the last question of the day here.
Thank you. Christoph, very, very interesting. Could it still be, and as you argue, I mean, there is clearly a disagreement about ESG. So it could be that you're not able to capture that because of ESG noisiness. I'm thinking here of a recent paper by Burke et al., where they show that if you instrument one ESG rating with the other ratings, they were able to better find, a relationship between ESG and returns. What do you think about that?
So I think I'm familiar with the paper that you're talking about. You're talking about this paper that instruments the different ratings on each other, right, and sort of tries to extract the part that is common to them, right? Yeah, I'm quite familiar with the paper. So a couple of things. So first of all, one sort of analysis that I didn't have time to speak about is in one test. What we do is we construct what we call sort of an uncontroversial ESG score, right? So we have a lot of disagreement between these ESG scores, but there are some firms on which they all agree those are good ESG firms. There are some firms on which they all agree these are bad ESG firms, and then there are all in the middle that they don't agree on, right? And so we try to construct this uncontroversial index to see if when we use that, we get a different result. And actually, it looks still quite similar. Another thing that I would like to think about in this context is that at the end of the day, we don't care so much if the ESG scores are true or not, as long as it's true that the investment community and these asset managers use them. It's interesting for us to find out if they affect portfolio performance or not. So that is, I think, another thing to keep in mind. But we're actively working on also having sort of an overlap with this paper that you talked about, in the sense that we can probably extract sort of a common component from these different scores to see if that common component is more informative, either in the form of conditional alpha or conditional beta.
Thank you.
Great, thank you. Well, thanks so much, Christoph. Great to have you back at Rotman, as it were, and thanks for that presentation and for everyone's comments. So to all the speakers, again, thank you for joining us today. To all the audience, thank you for joining us. It's been a really interesting and diverse set of papers, and I think really has brought a lot of new insight and knowledge to all of us on this subject of sustainable finance. So thank you, everyone, and we look forward to seeing everyone again soon.